Hello students. So students, a very good evening to all of you. Shelly, Mamta, Sunny, good evening students, good evening to all of you. So students, let's start on this particular discussion now. Students, I'll just let you know the first session. Amrita, good evening. So in the first session that we have done in the morning, I think we have done up till I think there was a brief power cut in between, so many students could not take up the sessions. It was continuing thereafter. So those who have to, Veti, good evening. Avdesh, good evening. So those who have to, in fact, because of the power cut that sometime that took place, they have to they went off. Just students, maybe one and a half hour session was there. Akash, good evening. So 1.5 hour session was there after that. So I will request to all of you to ensure on one thing, and what is that? That you just have a look to that 1.5 hour session. I think you would know from where you have left it. So please do ensure to complete that particular session, which was done in the morning. So it was till 12:30, around 12:15, around that time. The session was there. So students, right now, please pay attention to this one. We are discussing presently the income which is deemed to accrue or rise in India, and we were in this particular the assessment of interest, royalty and FTS income of the non-resident. Who is the recipient of the income? The recipient of the income is the non-resident. And what is the nature of the income which the non-resident have received? Interest, royalty and FTS income. So what we have discussed, students, if you all are aware, point number 1, that is to say, when the income in the nature of interest, royalty and fees for technical services deemed to accrue or rise in India, we have done that. When the income shall be characterized as royalty and FTS income, even the definition of royalty and FTS income, we have done this. Okay, in the morning session, we have done that. But there are some very important issue for May 22 attempt, that one case law which is very importantly, I will say one of the most important case law for your May 22 attempt is that one. So I'll be discussing that case law immediately sometime from now. And thereafter, students, assessment of royalty and FTS income, even that has been discussed by us. May I just put it, assessment of royalty, interest income, FTS income and one more income which is interest. So the interest income is also one of the category. So therefore, the assessment of royalty, interest income and the FTS income. So this is what we have done it. We all know that the royalty and FTS income, as we all can know, that it is assessable either under section 44 DA, that is the royalty and FTS income in this particular case is accessible on a net basis, or it could be also accessible under section 115A, which is on the gross basis. Whether it is 44DA or whether it is 115A, essentially depends upon the existence of the PE. But not only that the PE should be in existence, it is equally important that the services should be routed through that particular permanent establishment which is in India. Only then we will go to 44DA. Otherwise, the assessment of this royalty and FTS income will be under section 115A. Now, I have also done the compliance part, which was about whether there is an exemption to file the return of income which is available to the non-resident. I have done the interlinking of all the exemptions which are available to the non-resident so far as filing of the return of income is concerned. That was also done in the previous particular session. Now students, that was in part 3. So all the link of the lectures are given to you in the descriptive box. So in the description box, all the 4 lectures up till now that we have done it of the chart revision session is there in the description box. We will be continuing this particular sessions also next Saturday and Sunday. I have told you that around 44 hours is what I will be doing it. So 4 sessions are done. Next 4 sessions in the March on weekends, we are going to do that, and we will be nearly completing this particular chart revision series. So now in this context, students, the compliance part, I have told that there is an exemption to file the return of income which is available to the non-resident. There are some conditions, that is what we have discussed. Essentially, the condition is that the first, the non-resident should have only that portion of income which is specified, nothing. The income should not go beyond what is specified for the purpose of exemption. And the second one is that the TDS on those particular income should be deducted as per the Act rate. The TDS on those particular income should be deducted as per the Act rate and not as per the treaty rate. So if the TDS is deducted as per the Act rate, then definitely students, the exemption is available. So that is what primarily I've done, that particular part of the compliance part. And now first I will do the assessment of interest income, because it's quite a bit tricky in this regard. It is a bit tricky, students. It is a bit tricky, students, in this regard. So we will discuss this particular part, and thereafter, students, thereafter we will then move to the most important case law which I told you for May 22 attempt. But just before that, students, the assessment of the interest income, let's have a look to section 115A. Here comes, students, section 115A. The special provision for computing, here, this is the point. Interest, the special provision for computing the tax on the income by way of royalty, fees for technical service, interest, etc. Let's have a look, students. Now, dividend income, which we discussed in the morning session, it was about what? The dividend income received by a foreign company or a non-resident from whom? From an Indian company, that is always deemed to accrue as in India. The question therefore is, at what rate of tax that the dividend income will be taxed? So students, just be very clear on this point. The rate of tax to be applied in this case would be 20%. Now ICAI will try to put a doubt in your mind in the question by telling you about that this particular non-resident has got a permanent establishment in India. Be that as it may, whether the non-resident has a P in India or not, we don't care. Whatever is the dividend income which is received by the non-resident from the Indian company, that dividend income would always be taxed at a gross rate of 20%. That dividend income will always be taxed at a gross rate of 20%. Just keep that point always in mind. Now the next point is that of the interest income tax. Students, the interest income, if we look into it very carefully, we all know that the interest income rate is also 20%. But there is one caveat for that. This interest income, students, should be in respect of the loan which the non-resident or the foreign company has given to the Indian entity. That loan should be in the foreign currency. Only when the loan is given in the foreign currency, that the interest that is paid by this Indian entity to the non-resident of the foreign company, that will be assessable on a gross basis, and the rate would be at 20%. That will be assessable on a gross basis and the rate will be at 20%. Just keep that particular point in mind, students. Now here there is one very important aspect. Here, students, there is one very important aspect, and that is this. In one of the question, they have given us that the debenture, students, be careful. The Indian company has issued a debenture to the non-resident. The Indian company has issued the debenture to the non-resident. Obviously, the debenture is also a loan, but the debenture as an instrument when it is issued, it is issued in INR. And the fact that it is issued in INR, accordingly, the interest income earned by the non-resident on such debenture, the interest income earned by the non-resident on such debenture will be assessable at 20% rate. Will it be assessable at 20% rate? Answer is no, because this loan in the form of the debenture issue, this loan was not raised in INR. Manjeet first March को आ रहा है. 1 March को मैं चैनल में, टेलीग्राम चैनल पे अपलोड कर दूंगा. ठीक है ना? तो वो यूट्यूब वीडियो हिंदी में आ रहा है 1 March को. ठीक है? तो बस परसों का इंतज़ार करें और आपको वो वीडियो लेक्चर हिंदी में मिल जाएगा. ठीक? So students, in this particular context, please keep in mind one particular point. That the debenture which has been issued in the foreign currency, debenture which is issued, always it is issued in INR. So the interest income on that debenture will be assessable. The interest income on that debenture will be assessable at the rate which is applicable to that particular person. And if a person, say for example, is a foreign company, then what is the rate that is applicable? The rate that is applicable is 40%, isn't it? So that normal rate of 40% would be applicable. The special rate of 115A, which is 20%, is not going to be applicable because this debenture loan is issued in Indian currency and not in foreign currency. I hope that every one of you are clear with this part. Fine, so just keep in mind the debenture example because ICI definitely have done it in past, and why not? They will do it in future. Now comes the concessional rate of 5% tax rate. This is equally very important, students, that some portion, some interest income earned by the non-resident or a foreign company are chargeable to a very concessional rate of 5%. Some interest income earned by the non-resident or a foreign company are chargeable to a very, very lower rate of tax of 5%. You may ask, sir, what is that particular cases where this 5% rate of tax is applied? So just in a very simple particular way to just explain you that, just keep in mind the long-term infrastructure bond, if it is issued by the Indian company or the government as the case may be, which is subscribed by the non-resident, then on that case the concessional rate of tax under 115A, the concessional rate of income tax under 115A would be 5%. Would be 5%. Did you all got this one? Manjeet, this particular amendment book you have to take across online. So this chart book, students, those who want the chart book, again I'm just telling you, chart book, students, order from the shop, do a WhatsApp primarily. Herein, this WhatsApp, students, you can do it. For chart book, students, you can do the WhatsApp for this number, okay? 97794300034. Do the WhatsApp and accordingly follow it up with the bookshop. Now, students, in this particular context, what was the first particular case which I told you? The long-term infrastructure bond. The long-term infrastructure bond, if that has been issued to the non-resident, then in that particular case, the interest arising from that particular long-term infrastructure bond, the interest arising to the non-resident on such long-term infrastructure bond, that will be chargeable to tax at a very lower concessional rate of 5%. At a very lower concessional rate of 5%. I hope that every one of you are clear with this one. Thereafter, apart from the infrastructure fund, the next particular point is about the case of a business trust. The business trust, I think all of you are aware of the fact that the REIT, isn't it? So if supposingly I have subscribed to a bond issued by the REIT, and the REIT is the one who is making the payment of the interest to me. If the REIT is the one who is making the payment of interest to me, then in that particular case also, the rate of tax which will be charged on this particular interest income in the hands of the non-resident or the foreign company will be 5%. So this is also another concessional rate of 5% that is applicable. The third category, students, is the third and the last category, students, is the case of a rupee denominated bond. The rupee denominated bond, students. Now the rupee denominated bond which are being issued again by the Indian company to, say, a non-resident or to a foreign company, then the interest which is paid by that Indian company on that rupee denominated bond, the interest would be charged at the rate of 5%. The interest income will be charged at the tax rate of 5% as per section 115A. So therefore, they have targeted majorly the three categories. Which are those three categories, students? Repeat, for 5%, first one happens to be the long-term infrastructure bond which is issued and subscribed by the non-resident. The second one is the rupee denominated bond which is issued by the Indian company and subscribed by the non-resident. And the third one is the security issued by the REIT and subscribed by the non-resident. On those three category of the interest income of non-resident, the concessional tax rate under section 115A is at 5%. Is at 5%, students. Did you all got this one? Now there is one very important angle which I just want to discuss with all of you. If you permit, students, I will stretch up to that extent. Is the permission available, students? Is the permission available? then and only then I am going to stretch it up, students. Tell me, because these are the revision class. These are the revision class, students. Sunny, Amrita, okay, fine. Vethi, Shelly, perfect. So all the students are giving the permission. Perfect. Students, I want here to link this particular rate, the concessional rate, to the non-resident. If that non-resident is, say for example, a foreign company. Just take an example. Supposingly this interest income, which is taxed at the rate of 5%, and that interest income is received by a foreign company. Okay, now the foreign company, are they subject to a MAT? Is the foreign company charged to a MAT? Obviously, even they are chargeable to a MAT, but they have one condition, that the foreign company should have a place of business in India. If the foreign company is having a place of business in India, then yes, the foreign company would be liable for MAT. What we do in the MAT, students, what we do in the MAT is that the net profit as per the books, whatever is the net profit as per the books, we do add and we do less. There are some specified additions, there are some specified deductions, and by virtue of that you get the book profit. By virtue of that, students, you get the book profit. And now then, students, if by virtue of that you are getting a book profit, now please pay attention. There is one particular adjustment which you have to do for a foreign company while computing their book profit, and that adjustment is that if in the net profit there is any income, if in the net profit there is any income of that particular foreign company which is charged to a tax rate, at a rate which is less than 15%, which is charged to a tax rate under the normal provision, which rate? At a rate which is less than 15%, less than 15%, then that particular portion of the income will not form part of the book profit. And if that is the case, students, don't you think that these particular income if earned by the foreign company, is charged to a tax rate of what? 5%. And if it is charged to a tax rate of 5%, then will it be a part of the book profit calculation? And the answer is no. But what if a foreign company is earning an interest income? But that interest income is charged at the rate of 20%. Sorry, Amruta, that particular interest income is charged to tax at the rate of 20%. In that case, will this particular interest income, which is charged to tax at the rate of 20% as per the normal provision, will it also be excluded in computing the book profit? To that the answer is no. It will not be excluded in computing the book profit, for the reason being, in this case, the rate is more than 15%. So you have to be very careful in the MAT provision, because this is what ICI is known for. Did you all got this one? All of you? Now, one last point, students. Last point is this. Dividend income, as we can see here in students, the dividend income of a foreign company. Mamta, Sunny, Amruta. The dividend income earned by the foreign company, students, we all know that it is taxable at the rate of 20%. Please pay attention, the last interlinking. I am sorry, students, but I have to do so much of interlinking. I am helpless, because I just can't do a straight revision, because you will not be getting the question straight. You will get all the questions interlinked. And just supposing some students who are there who felt that, sir, it is bit going above the head, just hang on. Once you do maybe a second time revision, if you will have to do a second time revision, you will be in a position to connect those things very clearly. But I am trying my level best for all of you to make it understand here itself. But if at all, if you cannot connect those provisions which we are discussing, the interlinking that we are doing it presently, just hold on. let the topic come. I will do a quick revision. At that point of time, students, you will absolutely be clear about what exactly these things are all about. So I am trying to make an attempt to do a 2 times revision of all the interlinking which I am doing it, one here and the other one as and when I will do that particular chapter. At that stage also I'll do one last interlinking revision so that this concept gets firmly incorporated in your head. Students, just now I told you that if a dividend income is earned by a foreign company. Mamta, Sunny? Okay. If a dividend income is earned by a foreign company, then in that particular case, what did we said in this regard? We have told that if the dividend income is earned by a foreign company, then in that case the dividend income will be taxed at the rate of 20%. But there is one more rate of 10%, or there is one more rate of 10% tax which is applicable on the dividend income earned by the foreign company. You will say, sir, which is that rate? We are curious to know about it. Hold on. Students, what happened? Please pay attention here. As you all know, REIT has got a special purpose vehicle. There is a SPV, the special purpose vehicle, in which the REIT has done the investment. Primarily, the investment is something that they would have got through a shares, which they would have got it from the sponsors. So therefore, in that case, the REIT now is a shareholder of a special purpose vehicle, SPV, which is nothing but a company. Now what happens is that the SPV, the special purpose vehicle, will distribute a dividend, to the REIT. Now this dividend which is distributed to the REIT, this dividend which is paid by the SPV to the REIT, that dividend is not accessible in the hands of the REIT. That dividend is not accessible in the hands of the REIT. If at all it is accessible, then the same will be accessible in the hands of the unit holder. If at all it is accessible, then that dividend income received by the REIT from the SPV will be accessible in the hands of the unit holder of the REIT. So now then, in that case, the dividend income received by the unit holder from the REIT, that particular dividend income has got 2 rates. One is nil rate and another is a 10% rate. One is the nil rate and another is a 10% rate. Many students are asking, sir, nil rate when? And when it is 10%? Let me explain. The nil rate is applicable in the hands of the unit holder of the REIT when the SPV, the special purpose of vehicle, has not opted for the concessional tax rate under 115 BBA, the alternate tax regime under 115 BBA. So if the SPV has paid the tax on its profit as per the normal provision and not as per the alternate tax regime, in that particular case, the SPV who is there, in that particular case, the SPV who has paid the tax at normal provision and thereafter it has distributed a dividend to the REIT, the dividend which is distributed to the REIT but accessible in the hands of the unit holder, this dividend will be accessible in the hands of the unit holder at nil rate. Why nil rate? Because the SPV has not opted for the alternate tax regime, the concessional tax rate of 22% plus surcharge and HEC. But what if the SPV has opted for the alternate tax regime? If the SPV has opted for the alternate tax regime, in that particular case, what happens is that now they are paying the tax on their profit at the concessional rate, and the fact that they have paid the tax on their profit at the concessional rate, the dividend thereafter given by the SPV to the REIT, but which is accessible in the hands of the unit holder, this dividend which is going to be assessed in the hands of the unit holder will be taxed at the rate of 10%. This dividend which is going to be accessible in the hands of the unit holder will be taxed at the rate of 10%, and this is what this 10% is all about. This is what this 10%, students, is all about. So this 10% which they have specified over here, this is exactly what it is. This 10% that they are trying to tell you about it, this is exactly what it is. So therefore, just keep in mind this particular positioning. Keep in mind that depends on if the SPV has opted for the normal rate, not the alternate tax regime of 115BAA, then the profit which is distributed to the REIT in the form of dividend, that dividend will be accessible in the hands of the unit holder, and this will be assessed at the rate of nil rate. But if the SPV has opted for the alternate tax regime of 115BAA, then in that particular case, the SPV is subject to tax at a lower rate under 115BAA, and hence the dividend which is distributed by the SPV to the REIT but accessible in the hands of the unit holder, this dividend will be assessed at the rate of 10% in the hands of the unit holder. This dividend will be accessible in the hands of 10% of the unit holder. Is that clear to all of you? Congratulations, Pradeep. Yeah, definitely I do know. You were a very active participant in an academy. So very great to know. And my best wishes. My best wishes for your further journey way ahead. Okay, do well in life. God bless you. I hope that every one of you are clear with this particular concept, students. 10% rate versus nil rate applicable in the hands of the unit holder when it is nil, when it is nil, and when it is 10%, when it is nil and when it is 10%. Are you all clear with this one? Perfect, students. Amruta, Sunny. For November 22, Harshal, I will take. Mamta, for November 22. I hope that's Shelly. So now finally to conclude, students, the rate which is there, the rate as you all are aware, students, can you see that? The rate that you can see, dividend 20, interest also 20, subject to the fact that the loan is issued in foreign currency. That is what it is. However, the interest rate can go down to 5% in the case of long-term infra bond, in the case of rupee denominated bond, in the case of the interest received from the REIT. In these three cases, the interest income will go to 5%. The rate of tax will be charged at 5% and not at 20%. Fine. And as I told you, for the dividend income, 20% is the normal rate, but in one case it can go 10% or it can go nil also. That depends upon what is the position of the SPV, whether the SPV has taken the option of 115BAA or not. Where it has taken the option of 115BAA, then the dividend income which is distributed to the REIT but accessible in the hands of the unit holder, that dividend income will be assessed at a concessional rate of tax of 10% and not 20%. But if the SPV has opted for the normal rate of tax, not the special rate of 115BAA, then the dividend that is distributed to the REIT but accessible in the hands of the unit holder, it will be assessed at nil rate of tax. Magical. Good evening. I hope that all of you are clear with this one now. Every one of you are clear. So this was one of the very important discussion that we had, students. By the way, are you aware of this 4%, students? In one case, it can also be 4% instead of 5% rate. Instead of 5% rate, students, it can also go to 4%. Are you aware of that 4% rate? Shelly, that 4% rate is in the case of, I think, long-term bonds, rupee denominated bonds, which are listed in the recognized stock exchange of the IFSC. So same instruments, but listed where? Listed in the IFSC. If that is the case, students, then the interest income which has been paid will be taxed at a further concessional rate of 4%. At a further concessional rate of 4%. I hope that every one of you are now clear with this one. This is such an important discussion of the assessment of the interest and the dividend income of the non-resident. I should tell you one thing, students, that in the last December attempt, these people have targeted the assessment of the royalty and FTS income in the hands of the non-resident, not about the dividend and the interest income of the non-resident. So be mindful of this particular fact. If you all are clear with this one, now I come to the real game. Can you see that? This is what I expect to be there in your May 22 attempt. Be careful. A special and that most typical case of royalty taxation. A special and the most typical case of royalty taxation. First is this very unique case. This is, students, I may say that they are just outreaching. They are just trying to go beyond the limits. But what to do? This is what the law is. Students, as we have discussed in the morning class, that royalty income, as per the definition, includes the payment which is made towards the use of the equipment. So if the Indian entity has taken some very high-tech sophisticated equipment which it is using it, and on that they are paying a higher charges or a service charges to the non-resident, then those charges also will take the character of royalty income. This royalty income is known as equipment royalty. So therefore, students, we all know that through our satellite channel we are getting this particular all these satellite channels which are there. Just these satellite, primarily from the satellite, these are the links are captured. Please understand, the channels that we see, Star Sports, Sony, etc., Z and all, these channels primarily, they are getting those satellite links. In the satellite, primary students, there are two equipments which are there. Those two equipments are known as transponders and decoders. In the satellite, there are two equipments which are there, which are known as transponders and decoders. These channel company, they don't own these transponders and decoders. These are owned by some other foreign company which are large capital base. So I know one company, Asia Satellite Company, which is based in Singapore. Now what happens is that this particular satellite link primarily are captured in the transponder and decoder in the satellite, and that gets relayed to your home through the Tata Sky and all. Isn't it? Through the Tata Sky subscription that you may have taken it across. So therefore, all these companies which are all these channel companies which are there, Star Sports, Colors, etc., all these companies actually will have to make the payment to whom? To the Singapore company, that is Asia Satellite Company, to facilitate this uplinking and downlinking process. To facilitate this uplinking and the downlinking process. Again, the equipment which actually does those uplinking and downlinking are placed in satellite. But these equipment are owned by whom? Are owned by the Singapore company. Now the question therefore is, the payment which is made by these channel companies to the Asia Satellite Company in Singapore, whether this particular payment, can that be considered to be an equipment royalty? So students, just keep an eye on this. Whether that particular payment made by the channels to the Singapore based company, can that be considered to be an equipment royalty? Just keep an eye on this particular discussion now. What did I told you? When a particular amount can be characterized as an equipment royalty, I told you about the reason. The particular amount can be characterized as an equipment royalty if I am paying for use of these equipments. If I am paying it for use of those equipments, then yes, it can be considered to be an equipment royalty. It can be considered to be an equipment royalty. Okay, but the use will require what, students? If you say that, sir, I am using it. If I am using it, students, then it means that I either have a physical possession of those equipment so as to use it, or I have a control over that equipment so as to use it. And more importantly, those equipment also should be based in India. Even that is also one of the factors that may come into play. So these ingredients are required for using these equipments, using the equipment. But what about the transponders and decoders which are placed in the satellite? Is this channel company, are they having the possession over these equipment? No. Do they have the control over these equipment? No. Do they have whether these equipment are in India? Whether these equipments are in India? Again, the answer is no. So going by all these particular factors, we can say that the Indian company which are making the payment to this satellite company based in Singapore, they are not paying for using the equipment. They are not paying for using the equipment. And if you are not paying for using the equipment, then can this be characterized as a royalty income? Can that be characterized as a royalty income? Answer is no, it cannot be characterized as a royalty income. And if it cannot be characterized as a royalty income, students, I think all of you are aware of this part, that we will say it is not taxable as a royalty income. And therefore, the government would have felt bad about it, isn't it? The government would have felt bad about it. Just think for 5 seconds that if a particular amount cannot be taxed as a royalty income, then where it will get taxed? If at all it has to be taxed, then how it has to be taxed, students? In the hands of the non-resident, if it cannot be considered that this is not your royalty income. So just think about it. So if the government have to tax it, then how it can tax it? Obviously, then they have to take this as a case of a business income of the non-resident. So if I cannot tax this as a royalty income of a non-resident, then I will have to take this case as a business income of a non-resident. Only when it can be considered to be a business income of a non-resident that it could be taxed. But unfortunately, the business income will require a business connection, Sunny. The business income, students, will require a business connection. And if the business income will require a business connection, all you know, these satellite company which are there in Singapore, they did not have any business connection with India at all for the purpose of getting this particular income. So therefore, they need not have any business connection in India. And because of that reason, students, it can also not be taxed even as a business income. So neither as royalty nor as business income. So these payments, huge payments, which are made by all the channel companies to that satellite company which is based in Singapore, that will not be taxable at all, because it is neither a royalty nor it is a business income. So what the government did? The government accordingly have expanded the scope of the royalty definition. The government have accordingly expanded the scope of royalty definition. And what is the expansion? Let's have a look, students, over here. The expansion, students, yes, no, not business connection. They have expanded. Instead of choosing to tax it as a business income, they thought it appropriate to tax it as a royalty income. So therefore, what they did, see the student, this is what they have done it. Royalty includes consideration for use or right to use any industrial, commercial, scientific equipment. I told you already. But the most important point is to use. Using of the industrial, commercial or scientific equipment. Now, as per explanation number 5 to section 916, royalty includes a consideration in respect of any right properties, whether or not, students, can you see this word? Whether or not. This is the most important word. Whether or not. Whether or not what? The possession or control of such right, property or information is with the payer. This is when you use the term whether or not. Students, when you use the term whether or not, effectively you are making that term as redundant. Effectively you are making that term as completely baseless. So therefore, to consider an amount as an equipment royalty income of the non-resident, to consider an amount as an equipment royalty income of a non-resident, it is irrelevant that the possession or the control of such particular equipment is with the payer of the amount. Who is the payer of this particular amount? The Indian channel companies. Second point number B, it is also irrelevant that the property is used directly by the payer, means the Indian channel company are using that particular property, even that is irrelevant. And point number C, it is also irrelevant that the location or such right or property or information is in India. So that is also irrelevant, that whether that equipment for which the Indian channel companies are making the payment to the non-resident satellite company, that particular equipment may not be in India, it is still perfectly fine. This particular amount will still be considered as what? As a royalty income. This particular amount will still be considered as a royalty income. So students, please be very careful. In respect of an equipment royalty, we will not see these three factors. First factor, whether that particular equipment is in the possession or in the control or in the direct use of the payer of the amount, which is the Indian channel company. We will not see the location of that particular equipment, whether it is in India or it is in satellite. Absolutely irrelevant test. You will consider this particular amount as a royalty income, and accordingly on that basis, we will accordingly charge this royalty income for tax in the hands of the non-resident who is receiving this particular amount. This is such a dangerous particular expansion, and mind you students, IC has targeted this question one time. Once these people have targeted this question, so therefore I just want to caution to all of you. Now the most expected, as I told you, for May 22 attempt is this one. This part is the absolutely the most important and the expected question for the May 22 attempt. Now students, in this context, the case law, obviously you will not be in a position to remember the name. Engineering Analysis Center of Excellence Private Limited versus CIT 2021 Supreme Court. 2021 Supreme Court. Now first of all, I should give you a background of this, Shelly. No, you'll just write, you have to frame those points. You have to just write that for the purpose of equipment royalty, these factors are irrelevant, and accordingly, this amount which is paid will still be considered as equipment royalty, and therefore, this amount paid will be chargeable to tax in the hands of non-resident under the Act. This is how you have to frame it. Okay. Now coming to this particular part. So you have to list down those factors which you are considering to be irrelevant. Please pay attention, all of you students. The most expected case law for your May 22 attempt. To understand this case law, students, just try to understand a simple example first, and only then you will be in a position to understand this particular case law. I always give you the example, students. Just take the example of, please pay attention, students. Just take this example of, I am the author of that book, capsule book, which is published by Bharat Law House. Now students, I am giving a copyright to Bharat Law House. On that particular, whatever is the content, I am giving the copyright. To use that copyright, the Bharat Law House is producing the books. So they are exploiting the copyright and they are producing that particular books, isn't it? And thereafter, on that particular books, they are giving me the royalty. So I am giving the right on the content to Bharat Law House to exploit the same, and on the basis of which Bharat Law House, which is making the book out of it, they will be giving me the amount. Can that amount, can it be considered as a copyright royalty? Can I say that this amount is a copyright royalty? Answer is yes. Come to the second particular aspect of this case law. What if the books which are sold by Bharat Law House to you, can you be said that books which are sold by Bharat Law House to you, obviously that comes with a lot of restriction. Bharat Law does not give you the copyright to exploit this book and make more books out of it, isn't it? Actually, even photocopy is prohibited out of it, but still, in this context. So in that situation, students, the books which has been given by Bharat Law House to all of you, can you say that this is a copyright that you are paying to Bharat Law House? Will you say that the consideration that you are paying to Bharat Law House, is it a consideration towards the copyright? Is that what you are going to tell to Bharat Law House, that this is the price of the book, I am paying you the copyright? No, this is not a copyright. The amount that you people are paying to Bharat Law is the amount for sale of goods. The amount that you people are paying to Bharat Law House, you are making the payment for sale of goods. So please understand, what Bharat Law pays to me is a consideration which can be characterized as a copyright royalty, because I am giving the copyright over the content, and on that content they are exploiting the content, and accordingly they are making the books out of it. So therefore, whatever payment which the Bharat law will give it to me, that will be considered to be a copyright royalty. But the books which Bharat law house makes out of the copyright which I gave it to them, that books which has been sold to you primarily, that is not a case of a copyright royalty. That is a case of a sale of goods. But yes, I told you that there are a lot of restrictions that the Bharat law house is going to place in that particular context. Isn't it? Bharat law is going to place a lot of restriction. That is to say, this book is only for your use. You are not right. You don't have the right to reproduce the content out of it. All that thing is there in the copyright. This thing. Students, also one more point I want from you all right now. One more point. Students, is the books which Bharat law house gives, is it standardized with all the students? So all the books which are purchased by the students from Bharat law house, is it standardized? Yes. So that is a standardized book which everyone gets it, isn't it? So that is the background of the discussion. Now come to what this case law is all about. Let's come to what this case law, students, is all about. Be very careful about the case law, students, now. In this particular case law, students, in this particular case law, what has happened? The software, students, please pay attention on the software part. The software, students, which is a standardized software, like for example of a standardized software is a, say, operating system, MS operating system. Now the operating system, if I run in my computer, and the operating system that you will run in your computer will have the same result. Just like Bharat law house giving you the books, that also has the same result, isn't it? So the operating system which I run in my books and the operating system which you run in your computer, both will have the same function. All of you agree to this one? Yes. So this kind of a software is known as a standardized software. This kind of a software is known as a standardized software. Another example, if I have to tell you, is about the is, say, Tally software. Again, giving the same result. Please now pay attention. The example, this is very important. So Microsoft is, say, will have a distributor of the software across the world. So Microsoft will put the software, they will supply the software through, say for example, their distributors would be there in India. Just consider that. Maybe their distributor will be there in India. Now, and from the distributor, you get what? You get that particular operating system software. The operating system software. Once you open the operating system software, accordingly, there would be a key. You have to run that software in your computer. There would be a key which would be given. And once you put the key, what happens? The Microsoft server will catch the IP address. Or the system address from where this software has been run. So they will capture that. Isn't it? That is a process that you should know. Now you tell me one thing. I am paying the consideration to, say, to the distributor, and the distributor is paying the consideration finally to the Microsoft. Please tell me one thing. When the distributor is paying the consideration to the Microsoft, is that consideration paid by the distributor to the Microsoft, is that consideration in the nature of royalty? Is that a kind of consideration paid by the distributor in India of operating system? The consideration paid by this distributor to whom? To Microsoft. Is this in the nature of a royalty income of Microsoft? Is Microsoft earning a royalty income out of it? Answer is no. Please compare my example with the example of Microsoft. When I am giving copyright to Bharat law house, I am giving the copyright. What is what the Bharat law gets out of it? They get a right to exploit this particular copyright content and make a book out of it. Multiple books out of it which are being sold. And therefore, Bharat law house paying to me, can it be considered as a royalty? Yes, it can be considered as a royalty. But what about distributors in India who are making the payment? Do they get that right from the Microsoft that, look, I am giving you the copyright content, you exploit the content, make MS OS and sell it in India? Is that the kind of the right which the Microsoft will give it to the distributor? Is that the kind of the right which the Microsoft will give it to the distributor? Answer is no. That is not the right. They will give that entire software itself without the copyright which is there in it. They will give the entire software without the copyright which is there in it. And therefore the consideration which is paid by the distributors in India to the Microsoft, can that be characterized as a royalty income? Can we say that this is a royalty income? Answer is again no. It cannot be considered as a royalty income. I think all of you are clear up till here, isn't it? But you can say about the government, all of you students, you can think of the government, the greed of the government, what the government would have done. Amruta, Sunny, what the government would have done? The government in this particular case, they went one step further. And do you know what these people did? They said that even a copyright, please understand the distinction between the two. One is copyright, another is what? Copyrighted article. One is the copyright and another is the copyrighted article. So a copyright which Bharat Law House primarily pays to me for the copyright content, that is a royalty. But what the distributor is paying to the Microsoft, they are paying it for the copyrighted article, not for the copyright. So therefore copyrighted article should not be considered as a royalty. But government went further and they've said that in the case of computer software, even a copyrighted article will be considered as a royalty income. In the case of computer software, even a copyrighted article will be considered as a royalty income. Obviously, students, the government intention was very clear. What was the clarity of the government? That they want to tax such payments which are paid by the distributor in India to whom? To Microsoft or to such companies who are giving not the copyright but the copyrighted article to the distributors in India. So therefore the payment made by the distributors in India, the government wants to tax this amount as a royalty income. So as far as India is concerned, this particular payment became taxable. This particular payment, students, became taxable. As far as India is concerned, students, this particular payment became taxable in the form of royalty income. Now what about Microsoft? In its own country, US, it is a resident. In its own country, in US, it is a resident, isn't it? And in US also, because it is a resident, the world income will be taxable. So this income would also be taxable, students. This income will also be taxable. And if this income will also be taxable, this will give rise to double taxation. And if it give rise to a double taxation, then you will then go to the double taxation avoidance agreement treaty. And in the treaty, you will check the definition of royalty income. In the treaty, students, you will check the definition of royalty income. And when you check the definition of royalty income, do you think in the treaty also they would define royalty income to include consideration towards the copyrighted article? Do you think in the definition of the treaty this kind of a situation will arise where even the consideration paid towards the copyrighted article will be considered as a royalty income? Answer is no. In the treaty, students, you don't find this sort of madness. So they will conceive what is generally known as a copyright. And what is a copyright? Copyright means when the content is given for further exploitation for which the consideration is paid, that is what is known as copyright. Not when the copyrighted article itself is given for further distribution. Then that payment which is made cannot be considered to be a payment towards royalty. Then that payment cannot be considered towards the payment towards royalty. And this is what, students, now what happens? In the treaty, it will not be considered as royalty. So if it is in the treaty, students, if it is not to be considered as royalty, where it will be taxed then? It has to fall somewhere, na? To tax this particular amount, it will have to fall somewhere. Where it will fall? Definitely in the treaty, it will reject that this could be taxable as a royalty income. Because this cannot be conceptualized as royalty. It could be only be understood as what? As a case of a sale, and accordingly in that particular case, it, if at all, it would be considered as an income, it would be considered as a business income. If at all it will be considered as an income, it will be considered as a business income, students. So the treaty will take a position that, look, this consideration that is paid towards the copyrighted article cannot be considered as a royalty. The consideration paid towards the copyrighted article will be considered as a business income, And can you tell me, students, as per the treaty, when a business income becomes taxable in the source country? When the business income becomes taxable in the source country? Exactly. The business income, students, becomes taxable in the source country when that person has got a permanent establishment in the source country. So if that person has got a permanent establishment in the source country, only then the business income will be taxable. And as you all know, these foreign companies are merely doing a resale activities. They are selling it to the distributor, and the distributor further resells that particular goods. They are selling these particular item to whom? To the distributor, and the distributor further resells it. So the non-resident foreign company don't have any permanent establishment in India. So without having any P in India, can this particular consideration paid by the distributor to the non-resident foreign company, can that be taxed in India? And the answer is no. This is the answer as per the treaty. So treaty says it will not be taxed in India, which is a source country, for the reason being we consider this payment as a business income and not as a royalty, and therefore in this regard the business income in the hands of a person will be taxed in the source country only if that person has a PE in that source country. And in this case, since the PE was not there, whether this particular payment or the consideration, could it be taxed in India? Answer is no. Because that the PE was not there, therefore this particular consideration paid by the distributor to this non-resident foreign company was not taxable as per the treaty. So as per the treaty, not taxable. As per the act, because as per the act it is considered as a royalty, it became taxable. So you tell me now, which position the non-resident will prefer? Will they go as per the treaty or will they go as per the act? Definitely, students, in this particular case they will go as per the treaty, and we all are aware that the treaty overrides the provision of the act if it is beneficial to the SSE. The treaty overrides the provision of the act if it is beneficial to the SSE. And this is what this judgment is all about. This is what this judgment is about. So this judgment has to be divided into two parts. This judgment, students, Amrita, Sunny, this judgment has to be divided into two parts. Part number one. First of all, the characterization of this consideration. This judgment, students, just write a note of it, students. Note has to the how you will frame your answer. Note how you will frame your answer. Point number one. The characterization. Point number one. The characterization of the consideration. The characterization of the consideration. Shelly, Meenakshi. The characterization of the consideration paid on the copyrighted copyrighted article in the bracket, right? Standardized software. In the bracket, right? Standardized software. Bracket complete. under the treaty, and under the act and under the treaty. Under the act and under the treaty. That is your point number 1. When you have to frame. Otherwise, this case law, it's very difficult to understanding is one thing. But when you start writing it, then you come to know it is not that simple to write the answer on this case law. Standardized software, students. Standardized software example. If you want to write the example, Microsoft Office, MS Office is the example. So just briefly you will write below this, students. Briefly you will write below this. What you will write? Act says it is royalty. Treaty, not a royalty, but business income. Act will say it is a royalty, and treaty, I'm just giving the crux. Treaty will say it's a business income. This is point number 1. And the point number 2, students, the second point. Please write now the second point. So just below point number 1, Act says royalty, treaty does not consider this as royalty, but it considers this as a business income. Now, as far as point 2 is concerned, students, point 2. Please write point number 2. Section 90 provides treaty override over the act, treaty override over the act, if it is more beneficial. That is point number 2. And last point number 3, conclusion. Last point number 3, conclusion. Therefore, consideration paid by the Indian company on such licensed software. These are all licensed software. By the way, I'm using the word copyrighted article, but now let's use the real term. It is a licensed software. I'll explain you about licensed software. Just let me first conclude it. Point number 3, consideration paid towards the licensed software not taxable under the act, not taxable in India, and therefore the payer of the amount shall not deduct TDS under section 195. Full stop. Shall not deduct TDS under section 195. Full stop. Clear with this one, students, all of you. Now, you will say, sir, but what you said about licensed software, what does it mean? Students, I told you already. See, what Bharat law gives to you is a license book. Same way, what Microsoft gives, students, is nothing but a licensed software. This is popularly known as EULA. Licensed software, this is popularly known as EULA. What is EULA? End User License Agreement. So, you have to accept first. When the software has to be run in your computer, you need to accept it. The moment you accept it, that particular license is granted to you. and that therefore you are now set to be using a licensed software. Same way, when you purchase the textbook from Bharat Law House or purchase a textbook, you actually are giving an undertaking of what? That I am in possession of a licensed copy, which is licensed to use but not to reproduce. Licensed to use but not to reproduce. That is what is an undertaking which you give when you buy a textbook. So you are giving an undertaking of license to use but not the license to produce. But what I have given to Bharat Law House as an author, I have given Bharat Law House as an author the license to reproduce the copies. So therefore, the moment I give that particular license to reproduce the copy, Bharat Law House making the payment to me becomes a case of a royalty. But if it is simply a case of license to use but not license to reproduce, if it is simply a license to use but not a license to reproduce, then in that particular case it will be not considered as a payment towards royalty. It will be at the most taxable as a business income, but for a business income to be taxed in the country of source, you require a business connection of that non-resident or a permanent establishment of that non-resident under for the purpose of the taxability of such business income. And that exactly what it is. I hope that all of you are clear with this one. With this, students, we are done with the most crucial part of your discussion, and that covers up your entire stuff. Students, those who haven't seen the morning lecture, again I am repeating this part. If you have liked the explanation, ensure to like this particular video also, students. So that is a consideration that you are paying. Don't worry, by liking it, you are not paying a royalty. By liking it, you are not paying the royalty, students. Don't worry about that. Okay, because there would be a terror in your mind whether royalty definition is so vast that by liking the video, will that be considered as a royalty? That thought will come in your mind, students. Don't worry, it is not to be considered as a royalty amount. Fine, students. Now, students, there are some section 10 items which are there over here, but I will choose to skip this section 10 item right now. In the morning session, students, I have done 2 items of section 10, which was essentially for the salary income. Students. In the morning session, I have done this section 10 item, which was essentially for salary item, but I will do the remaining section 10, majorly the amendment item, in my next class, students. Because somehow students get frozen when this section 10 is discussed. So I want to get you frozen at right point of time, students. I want to freeze you at right point of time. You'll say, sir, which time will be? The time will come, students. Don't worry. Your time will also come where you are going to get freezed with this section 10 discussion. Are you ready to get free, students? Or frozen, as the case may be? To that, the answer is yes. Isn't it? So we will discuss that particular point at the suitable time. Don't worry about this. In my next session, I will do this section 10 items for the non-resident, which includes some critical amendments as well. Okay. Why I am choosing to just skip it? There is obvious reason, students, because I am discussed enough of treaty right now with all of you. And because I have discussed enough of treaty right now with all of you, I definitely want to discuss the double taxation avoidance agreement treaty. I want to discuss the double taxation avoidance agreement treaty right now. But before I go to double taxation, in the morning class, those who are wondering, students, what about the morning session you're talking about it? In the description box, there are already 4 videos now. This is the 4th part of our chart revision, which is going on. So this is the 4th part, okay? So in the description box of this video, you will definitely find. And the remaining parts, Saturday and Sunday, we are all meeting 5 to 10 on Saturday, and on Sunday, morning 7 to 1. Only today, because yesterday I could not do it, I have done on Sunday 2 times, but always it is Saturday evening and Sunday morning. Students, 115 BBA, I think I have discussed this point. So just a formality, I am having it. Students, majorly we are focused mainly on the non-resident sports person. Just always keep in mind, one question was asked, what about the athlete? Sorry, this is applicable only when I'm just trying to discuss now, not the provision. Every one of you know the provision. Just important point. Ensure one thing, students. This is applicable only to that non-resident sports person who is not a citizen of India. Because even Virat Kohli, I am very sure that he may have become non-resident. And if he becomes non-resident because their matches are so played outside India, that in that particular case, if he becomes non-resident, 115 BBA may not be applicable. Sorry, he will try to tax himself under 115 BBA at the concessional rate of 20%, because then his income otherwise is taxed at higher slab of 30%. So that not to happen, students, they have ensured to give you this condition that this 115 BBA provision of 20% rate will be applicable to that non-resident sports person who is not a citizen of India. That is point number 1. So Virat Kohli, even though he may be a non-resident, he is out from taking the advantage of 115 BBA. Point number 2, students, in this case, it is for a sports person, not for the umpires and all. Be very careful, because in ICI, in one of the questions, they have already targeted this thing. So for umpires and all, that would be the normal professional income. So that will go under the normal category, not under this category. And last but not the least, students, non-resident entertainers. In one of the questions, they have targeted the entertainers also, like Michael Jackson, who was there earlier. He came in India. For him, whatever is the income that he earned from the performances, that income got taxed under 115 BBA. The rate, as you all know, the TDS rate under 194E was made applicable, and all we are aware that 194 TDS rate has to be loaded with the HEC. The 194 194E TDS rate has to be loaded with HEC. Remaining points I have already discussed now, and as well as in the morning class. So I am not discussing it further to avoid the duplication. Please come to this topic on double taxation avoidance agreement now. The double taxation avoidance agreement, students. Now this topic, as you people are aware, that this topic in one way or the other keeps coming up in the examination. This topic, students, in one way or the other, this keeps on coming in the examination, isn't it? So always the chances are very high. Always the chances are very high so far as this point is concerned. Now they can also use even the integrated case study mechanism to target this topic. There are a lot of avenues available with the ICI to target this topic. First of all, students, please try to remember this point. One, there is a distinction between two double taxation. This was asked in the December 21 attempt. Distinction between economic double taxation and juridical double taxation. What is the distinction between the two? So juridical double taxation means, obviously, in one country you are getting taxed on the basis of the source rule of taxation, and in another country you are getting taxed on the basis of the resident rule of taxation. So whenever the same income is getting taxed twice in the two countries, then in that particular case we say it is a jurisdictional double taxation. Which double taxation? Jurisdictional double taxation. But however, in this case, what about the economic double taxation? So obviously, whenever there is a jurisdictional double taxation, we need to give that particular person relief so that the income is not getting taxed twice in the two countries. So relief needs to be given to that person. How the relief will be given, we will discuss it a bit later. But before that, economic double taxation. Students, the economic double taxation which you are reading right now, this as such is a problem which is manifested in the law itself. This is actually a problem which gets manifested in the law itself. How it gets manifested in the law itself, I'll tell you the problem. All of you will just pay attention to the problem first. In the case of an economic double taxation, student, what happens is this, that supposingly there is a partnership firm. And that partnership firm, obviously they would have earned their profit, and from their profit there will be a post-tax profit. They will have a tax on that profit. So on that profit, the firm has already paid the tax. Now the profit get distributed to the partners. Now if you say that the profit which is distributed to the partners also needs to be taxed, then this is what I say, students, is a double taxation now. Because this profit was taxed in the hands of the partnership firm. Now the profit when distributed to the partner, again it becomes taxable in the hands of the partners. So that will give rise to double taxation. Now what did I told you? Just now, students, I told you the economic double taxation issue arises from the act itself. So if the economic double tax, because obviously the act has partnership firm, the act has the partner, the firm has the profit. On that profit, the firm has paid the tax. Now, after paying the tax, it will distribute it to the partners. So the partner are recipient of the profit. So since the issue of economic double taxation is arising from the act itself, the solution also needs to be given in the act itself. The solution to address this issue also should come out from the act itself. And that solution, students, that solution is through the exemption route. That solution, students, is through what route? The exemption route. So students, always keep in mind, India has taken the exemption route for economic double taxation. India has always taken the exemption route for the economic double taxation. So accordingly, the classic example is the profit earned by the partnership firm is taxable in the hands of the firm, and thereafter the profit which is distributed to the partners, that particular profit, to avoid the double taxation, to avoid the economic double taxation, that the act has granted the exemption. So to address the economic double taxation issue, the relief is provided under the act. The relief is provided under the act through the exemption route. Okay? Through the exemption route. All of you agree to this particular point, students? If that is the case, students, now let's see what happens in the case of a jurisdictional double taxation. So here, students, you have to be very careful, because this is what they will be getting the questions in the examination. For the sake of a repetition, or on the risk of the repetition, I must tell you one important thing which I have told you, I think, in the previous session also, but still I will prefer to tell you. In the examination, students, ICAI now is playing a very smart game. Please try to link this chapter with individual taxation. An individual having, they will target the residential status. They will target the residential status of the person. Chances are very high. Section number 6. Plus thereafter, once on the basis of this, students, you all are aware that that individual can become a resident or a non-resident. Isn't it? A resident or a non-resident. If he becomes a resident, I am telling you, these people will take you to a ride under 1991. These people will definitely take you for a ride under 1991. Okay. Whereas if he is a non-resident, because of this residential status, for an individual, I have told it and I am repeating this point again, whether 115 BAC, will that be applicable? Is it applicable? The alternate tax regime? The alternate tax regime for a non-resident individual. An individual who is a non-resident, do they get the alternate tax regime of 115 BAC? What is your take on that, students? Whether they do get the alternate tax regime of 115 BAC? And the answer is indeed yes. And the answer is, students, indeed yes. They do get this alternate tax regime benefit. And that is what these people are going to test you. Okay? Amrita, Mamta, Sunny. And that is what they are going to test you on this. Are you ready for this one, students? This is how these people are going to test you. Some students, okay, by the way, here last attempt or maybe last attempt, if 90 and 91 is there, expect even in this case 115 BAC can come into picture. Even in this case 115 BAC can come into picture. Because the moment there is 115 BAC, there are some heavy bulldozing that take place under the act. there are heavy bulldozing that take place under the Act. What sort of bulldozing? Lot of deduction has to be given up. Lot of deduction has to be given up. If you have got a salary, standard deduction is out. If you have Chapter 6A, even that has to be foregone, except for couple of items. So these are the things which are to be given up. Along with that, if you have got a house property, even the loss under the head house property will not be allowed to be set off. The loss from the head house property will not be allowed to be set off from the income of any other heads. So there are a lot of constraints that will come into play under 115 BAC. But yes, agreed, the tax rate under 115 BAC is indeed on a lower side because the slab rate is changing only up to 2.5 lakhs till 15 lakhs. Till 15 lakhs, the slab rate changes only 2.5 lakhs, and that is the biggest advantage. So just have an open mind, students. Don't expect that in the examination they will ask only. Don't expect in the examination they are going to ask only 90 and 91. Definitely they will not do that. They will definitely try to influence this with further more things. This is a kind of a question which comes in the examination in the recent times. Let's see what it is. Now, on the context of double taxation. Now, I have quickly again, I will just recap that example because this example always revises and refreshes the entire area of the double taxation. So I'm quickly revising with all of you this particular double taxation relief topic. So here in students, always whenever the question comes in the examination, check it out that what is India status and what is the foreign country. Let's take this foreign country as USA. So whether if India is a COS country of source, meaning there, but COS full form is country of source, and maybe the USA, they will make this as a country of resident. USA students, they will make them as a country of resident. You will say, sir, what is the difference? Resident means like Mr. Donald Trump. He is a resident of USA. His world income will be taxed in USA, isn't it? He has got some income in the form of Trump Towers, from which he is getting a royalty. So in that particular context, students, he is in receipt of a royalty income from the Trump Tower. The name itself, isn't the trademark patent, is what is earned by Mr. Donald Trump from India. So in that particular case, students, royalty income primarily, accordingly, as per section 916, it is an income which is deemed to be accruing or rising in India. It is an income which is deemed to accrue or rise in India. And thereafter, in India, it will be taxed under section 115A. In India, it will be taxed under section 115A. What is the rate of tax? The rate of tax, you all are aware. For the royalty taxation, students, under 115A, the rate of tax happens to be 10%. The rate of tax happens to be 10%. When it goes to over here, students, be careful. In USA also, this is taxable because the world income is taxable in USA. In USA also it is taxable because the world income is taxable in USA, and therefore it gives rise to a double taxation. Therefore it gives rise to what? A double taxation. Do you all agree? Now, considering the fact that the DTAA exists, students, you have to be very careful about the language of DTAA. Considering the fact that the DTAA exists, you have to be very, very careful about the language of DTAA. Now, what could be the possible language of DTAA? The language of the DTAA could be point number 1 to situation number 1. So, situation number 1 is that the royalty income or this income shall only be taxed. When they say only be taxed in COR, means what will happen? Then Mr. Donald, then in this particular case, this royalty then could not be taxed in India. So if this is the language of the DTAA, situation 1, this is the language of, students, by the way, DTAA. So what DTAA says? As per the situation number 1, the royalty shall only be taxed in COR. Only be taxed in COR. It inherently implies that it cannot be taxed in the COS, which is India. Isn't it? And if it cannot be taxed, students, so accordingly, as per treaty, as treaty is more beneficial, as treaty is more beneficial, it cannot be taxed. In CUS is country of source. In our example, it is India. Now, definitely you all will agree that Mr. Donald Trump is taking the treaty benefit. And if Mr. Donald Trump is taking the treaty benefit, students, all of you will agree that he will have to furnish TRC. So TRC has to be furnished. TRC is tax residency certificate. So TRC shall be furnished in this case, because Mr. Donald Trump is availing the treaty benefit. Wherever the treaty benefit is taken, the TRC is mandatorily to be furnished. The tax residency certificate is mandatorily required to be furnished to the payer of that amount in the source country. So that that particular payer will ensure not to tax that particular amount in this case. So that that particular payer will ensure what, students? He will not tax that particular amount. Okay, that is what it is. Consider situation 2. Consider a second situation. If the treaty says, let's see the second case scenario. If the treaty says, students, that in this context, be very careful. It's all new course. Welcome, students, to CA final now. It's all new course. Gone are the days of the old course. But in fact, in the old course also, these people used to give you the treaty provision. But now, as you all are aware, in the new course, students, it will only be in the new course you will expect these sort of application-oriented questions in the international taxation of your paper number 7. So you need to at least have the reasonable ability to apply. By the way, this sort of paragraph was already targeted in the old course. So old course already have gone through it. So it is reasonable to expect that even the new course definitely would be loaded with these sort of application-oriented paragraphs of the treaty, and giving a situation, they will ask you, please tell us how do you go about it. Please tell us how do you go about it. By the way, students, you all know the Ukraine and Russia conflict which is going on, isn't it? The UK-Russia conflict which is going on. Every particular crisis at least should be looked as an opportunity from the student's perspective. So what is opportunity? Are you going to say that I can become a superpower? Why not, students? Why not? The opportunity in this case is that try to link this concept. Pandu, Amrita, Mamta, all of you are aware of the happenings. Heart goes to those particular visuals which comes in this particular the televisions and the other particular sites and all. It's really, it's something which is, well, you cannot even wish this for your enemy. That's primarily what it is. Those things even you cannot wish for your enemies. So that is what it is. But what to do, students, now? Something which is now beyond your control. But what I meant by students, yes, what I meant by this particular thing, this Ukraine and Russia conflict, there is a theory topic which is there. Are you aware of it? In your non-resident taxation and international taxation, you people have got some extra theory. And there is a chapter known as what? The Principle of Interpretation of Tax Treaty. Chapter known as Principle of Interpretation of Tax Treaty. In that particular chapter, there is one very particular article, Pacta Sunt Servanda. Heard of it, students? So what Russia is doing right now, students, is violating this principle of Pacta Sunt Servanda. In fact, you can also write these things in your examination, isn't it? What Russia right now is doing is violating the principle of Pacta Sunt Servanda. And what is that, students? That whatever is a treaty which has been made should be implemented in good faith. Should be implemented in good faith. This is the core principle of the international agreements. So definitely these are the international agreement. Accordingly, students, what they have done, all the agreement, they have already slashed it. I'm not taking any sides, by the way. Don't think that I'm favoring one country or the country. No, I'm just trying to make you understand that they have gone and overridden everything, whatever agreement that they have done it. So they are through their action, students, through their action, they have shown the intention that we are not going to honor those agreements. Now, there will be a repercussions on that. What about the other agreements? Say, for example, there is a water agreement between Ukraine and Russia. Do you think that these agreements will now survive? Will those agreements will survive because of this conflict? Answer is no. And therefore, students, this entire chapter which you have got, we will try to understand from the perspective of Russia and Ukraine crisis. From the perspective of Russia and Ukraine crisis, and that chapter will get over. That theory chapter will get over. The interpretation, yes, Shaili, Article 26. The interpretation, principle of interpretation of tax treaty is that particular this thing. We will discuss those things. Is that clear to all of you, students? So we will try to make as contemporary as possible our discussion, students, so that you can relate what is happening versus what you read. Otherwise, if you read without relating with the events, I'm telling you, students, the topic is as good as, the topic is live or alive as till the time it is in front of you. The moment you close the book, students, it's all gone. So, students, these are the ways to really approach certain topic, and that is what I meant by always try to find an opportunity in the crisis. So, students, situation number 2. What if the Dtwa says, students, please pay attention in this case. What if the Dtwa says what? Says that students, says what, but sir, says that the royalty income, this is second situation, by the way, may also be taxed in the COS. What is COS full form? Country of source. May also be taxed in COS, but at a rate, may also be taxed in the COS, but at a rate not more than, now there are two different cases, students. Point number A, case 1, case A, say the case A is, in this case, say 5%, or case B is say 15%. There are two independent cases. Okay. Please, students, let me know if you all are through with this. Please do let me know if you are through with this, students. Are you all through with this one, students? So now you tell me, if the treaty gives the right even to the country of source, which in my example is India, students. If the treaty gives the right even to the country of source, which in my example is India, what do you think, students, in this case? Whether in this particular case India will tax it? Why not? Given the right, why not? We will tax it. We will tax it, and definitely India will tax it. Now you tell me, what is the act rate for royalty income? What was the act rate for royalty income under 115A? 10%. What is the treaty rate? 5%. So tell me in this case, whether they will invoke the treaty, whether Mr. Donald Trump will invoke the treaty to obtain the concessional rate. And the answer is yes. All of you agree to this one. Mr. Donald Trump will invoke the treaty to obtain the concessional rate of 5%. He will definitely invoke. And students, by doing this, be careful. By doing this 5%, this is what will happen, students. I hope that by doing this, so he will invoke treaty. Invoke treaty to obtain the concessional rate. The concessional rate. Now you tell me, students, if he is invoking the treaty to get the concessional rate, if he is invoking the treaty to obtain the concessional rate, in this particular case, whether the TRC will it be required to be furnished or not. If he is invoking the treaty to obtain the concessional rate, whether the TRC, what is the full form of TRC? Tax Residency Certificate, will that be required to be furnished in this case or not? Mr. Donald Trump has to prove or establish that he is a resident of USA and therefore he wants to take the treaty benefit. He is a resident of USA and therefore he wants to take the treaty benefit, and the answer is yes. So TRC, will that be required to be furnished? Answer is yes. Answer is yes. Isn't it? And that exactly is the point, students. Now what about case number B? Case number B, 15%. Now what do you think? Mr. Donald Trump, in this particular case B, will he like to invoke the treaty anyways? Will he like to invoke the treaty anyways? What do you think of it, students? In the case B, will Mr. Donald Trump, who has earned the royalty income in India and the treaty provides the taxation right to India as well, so in that case, the income will be taxed in India. The rate as per the act is 10%. The rate as per the treaty is at 15%. Do you think Mr. Donald Trump is going to invoke? Do you think Mr. Donald Trump is going to invoke the treaty rate in this particular case? And the answer is obviously no. So no. So act more beneficial. Act more beneficial. And if act is more beneficial and treaty is not invoked, then TRC in this case, will it be required? Tax residency certificate in this particular case, will it be required? And the answer to that is no, students. And the answer to that is no. I hope that every one of you are clear with this one now. All the students got the clarity. Fine, students. Now, if you are done with this, because this is a case study of highest importance, because this is what IC has done it in the past. But I have told you, students, in the double taxation avoidance agreement, always keep an eye, what is the status of India? What is the status of India, students? Always keep an eye, what is India? Is India a COS? In my example, in this example, India, I made this to be a country of source. And country of resident of I made Mr. Donald Trump as the SSE. So the country of resident was USA, country of source was India. Always keep this point in mind. What is the status of India? Is it a COS or a COR? Because in the next example which I am giving it to you now, I am deliberately making, students, India as a case of a COR, because only then the double taxation relief will come into play. Only then, students, the double taxation relief will come into play. So let's make India great again. Remember that slogan in this context, students. So India I am making as COR and USA I am making this as COS. India as a COR, USA as a COS. So the example also has to be of what? Mr. Donald Trump? No, India means Mr. Patel. So Mr. Patel of India. So obviously in this context, the Indian feeling comes into picture. So Mr. Patel, he is a COR. Now he has earned some income in US, whatever be the income. Okay, say interest income, or maybe it's say royalty income, whatever be the income. Are you aware of that, students? Let's stick with royalty only, because something great may come up. Who knows, isn't it? So what happens, students? Royalty income, as per the US tax law, their domestic tax law, it will be taxed. And in India, we all are aware that the world income is taxable. World income is taxable. So in that case, in India, it will also be taxed. So in this situation, is there a double taxation which is there in this context? Yes, indeed. There is a double taxation in this context. Okay. Now let's have a look to the treaty. Same position in the treaty, students. The treaty may say what, students? Point number one. Only, so situation number one. What was situation number one? If you can recall that, students. Situation number one. In the treaty, the Dtwa treaty says that the income, royalty income, only be taxed in COR. So if it is only be taxed in COR, so accordingly what happens? So in this case, only India will tax it. Only India will tax it. Isn't it? Only India will tax it. The relief is resolved. The double taxation relief is resolved. But the second case is the most important and dangerous one. Keep in mind, students, the second case. As per the Act now, also as per the treaty, situation number 2. This is where your chapter unfolds, 1991. As per the treaty, students. What is there as per the treaty or Dtwa? The income may also be taxed in COS. In COS. So if the income may also be taxed in COS, students, then in that case, what will happen? If the income may also be taxed in COS, students, then what will happen? Then US will tax it. US will tax it. What India will do, students, here in this context? India, what they will do now? In that case, you will say, sir, even India will tax it. So if you say that even India will tax it, then again there is a double taxation. Where is the relief? If you people say, sir, India will also tax it. If you people are saying that, then again the double taxation exists. So students, in this case, be careful. India now need to act. India now need to act. And accordingly, how they will have to give the relief, students. Please be careful. The double taxation that is taking place, and the treaty says that the income, royalty income, will be taxed only in the COS, which is US. The royalty income may also be taxed in COS. May also be taxed in COS. So US will tax it. US will tax it. Students, can I just try to modify this particular example a bit? Because this is also one of the attempt. I remember that old attempt question now, November 17 attempt. They have said that the income shall only be taxed in COS. But can be considered in India for rate purpose. But can be considered in India for rate purpose. One time they have targeted this question. Beautiful question. People got stumped completely. They got stumped, students, by virtue of this. They have given the language itself. The income shall only be taxed in COS, but can be considered in India. In India means COR. What is India? That is a COR. It is in Mumbai, Vijay. But can be considered in CUR for rate purpose only. For rate purpose only, students. If this is what they have said it, now please pay attention. How you have to interpret this? Please pay attention, students. Supposingly, the royalty income, students, let's have a number to it now. Because it's high time now we need to have a number over it. Otherwise, we cannot proceed further. The royalty income, students, say 3 lakhs. Okay, royalty income that is earned in US. Earned where? In US is 3 lakhs. And the Indian income, students, Indian income is say around 9 lakhs. Okay. So, what do you mean by this particular statement now? How you have to work it out? Students, how you will have to work it out this part? Quickly. This is a very crucial state that you people are in. How you need to work it out in this case? So here, students, the Indian here income, first you have to calculate. Only you cannot tax this particular, students, as per the treaty, which very clearly says, as per the treaty, this shall only be taxed in CUS, but can be considered in CUR for rate purpose only. Okay. So students, the first step therefore you have to do is calculate the tax rate applicable in India. Tax rate effective applicable in the case of Mr. Patel. In the case of Mr. Patel. So in that situation, students, how you will have to calculate? So students, quickly, can you give me the 12 lakhs? Whatever is the tax liability till HEC? Tax till HEC, students. Quickly, you people. And don't take 115 BAC, go as per the normal calculation. Up to 10 lakhs, students, I can help. 1,12,500. After 10 to 12, 2 lakhs. 30%. So it is 60,000. So it becomes case for 1,72,500. Please load 4% and tell me the final answer. Please load. The answer is, students, 179,400. Now, can you tell me, Amrita, what is the percentage over here? The percentage, Sri. What is the percentage? The effective rate, percentage. This is what is only allowed. This is what is only allowed. Please tell me the percentage. 179,400 divided by 12 lakhs. 179,400 divided by 12 lakhs. Quickly, students. 14.95. 14.95%. Now, this 14.95, Mamta, you are going to apply on this total income. Now, total income of Mr. Patel. Is, be careful, students. Sherry, of Mr. Patel is what? Only Indian income they can take. Unfortunately, students, only Indian income. Because as per the treaty, it will be taxed only in the country of source. Country of resident has only one limited option to consider this income only for rate purpose. So this is the Indian income and that is it. That is it, students. This is your total income. That is it. And on that, apply the tax rate of 14.95%. 14.95% on this. Can you get me the answer? Final answer. The final answer, students, in this particular case. Quickly, students, what you are waiting for? How you are going to complete the paper? Quickly, get me the answer. On 9 lakhs, 14.95%, students. 1,34,550. So this is the tax line. This is what it is. That exactly what you will do. So this is how the presentation will go in your examination. This was targeted in your May 17, November 17 attempt. After this, students, if you all are done with this, I now come to my last situation. Students. And the last situation is situation number 3. And in your examination, if India happens to be the country of resident, your question would be only one out of the three. Okay, be very careful. The 3 situations which I have given it to you, you will always find the case study revolving in one of the 3 situations. Always keep in mind this. So situation 3 says what? Dtwa says the income, the royalty income may also be taxed. Can you see this? May also be taxed in COS. Sorry. Yeah, COS. I would copy it on this one, students. The Dtwa says the royalty income may also be taxed in COS. So if it may also be taxed in COS, students, I think all of you are aware of it. What is the take in this case, students? If it may also be taxed in COS, students, then what is the take herein? US will tax it. But is it an exclusive right given to the US? Is it exclusive right given to the US to tax it? No. May also be taxed. So definitely it means that the tilt is towards India, that is country of resident. But yes, they are giving this right even to the country of source that they can also tax it. So if they can also tax it, then what India will do? So this is a COS, country of source US, so they will tax it. What about India? India is a COR, the country of resident. The country of resident is India. What India will do, students? Now, as you all know, students, India, in this particular case, the relief, you will say, students, that here, whether India, just like situation number 2, will they exclude it from the total income computation? Just like in situation number 2 that you did just now, will they completely exclude this particular royalty income, the foreign income, in the total income? Answer is no. India does not, if the treaty has not stopped India, just like situation 2 where it got stopped. That is therefore the reason it could not consider the royalty income as the part of the total income. But if the treaty does not stop the country of source, in which case it is India, from taxation, then India will definitely include that foreign income in the total income. India will definitely include that foreign income in the total income. We don't give the relief under the act. See, if the treaty stops you, then you can't do anything, just like situation number 2. But if the treaty does not stop you, will you consider that foreign income as a part of your total income? Answer is yes. Will you consider the foreign income as a part of the total income? Answer is yes. You will definitely consider that foreign income, students, as the part of your total income. I hope that all of you are clear with this one. All of you. So here in this particular case, Indian income, see the presentation, 9 lakhs. Foreign income, students, 3 lakhs. The royalty income. Foreign income here in my example is royalty income. So this royalty income, primarily 3 lakhs, you will consider it because we don't then follow the exemption method. But you will say, sir, then double taxation is happening. Don't worry, students. Double taxation is happening. I am also understanding this. But hold on to this one. Say 12 lakhs is your total income. 12 lakhs tax liability already you have calculated, students. Tax liability already you have calculated above on 12 lakhs. What was that? 179,400. Okay, then the Indian rate is what you will calculate after this. The Indian rate is what you will calculate, and what is Indian rate? Same. Nothing changes. Nothing changes, students. So the Indian rate is what you will calculate, and this is 14.95%. This is 14.95%. This becomes the Indian rate, students. This becomes the Indian rate. 14.95%, students. I hope that every one of you are clear. Now, you will from this tax liability, students, yes, from this tax liability now. So this is the Indian rate, which you all know. Now from this tax liability, you will grant the relief. Relief of the eligible rate, which is the lower of the two. The relief of the eligible rate, which is the lower of the two. And the lower of the two rate would be, say for example, herein, the foreign income, this was taxed in US at the rate of 10%. In US, say for example, it is 5%. For example, the royalty income is taxed in US, students, say at the rate of 5%. Consider this, students. Just write in the case study. In your case study, please write this as 5%, where this was taxed in US. Okay. Now with 5% in this context. So eligible rate, lower rate, which is the Indian rate and the foreign rate, multiplied by the foreign income, which is doubly taxed in both the country. Doubly taxed in both the countries. Students, in fact, this is what you people will encounter now. Eligible rate is a lower rate into the foreign income, which is doubly taxed in both the countries. Doubly taxed, students, in both the countries. Have you all copied down this one, students? Means that foreign income, which is doubly taxed in both the countries. This is what we will decode it now. Students, this is what we are going to decode, because in your ICI practical question, this is heavy bombarding. In your ICI practical question, this is where the heavy bombarding comes. This is the place where the figure changes. And this is where the students make a huge mistake. This is the place where the students make a huge mistake. So the lower rate we know, 5%. So we know the answer here, it is 5%. 5% on what? Foreign income. In this case, the question was very simple. The question was very simple. So it was 3 lakhs. So 5% of 3 lakhs comes to how much, students? It is 15,000 rupees. This was very simple thing. You got it, this thing. And accordingly, now the tax liability of 1,79,000 minus 15,000. That is the relief. Now this relief, students, is under 90 because treaty existed. This relief is under section 90. This relief, students, is under section 90. Why? Because there is a treaty which exists. There is a treaty which exists. So therefore the relief which was being granted is under 90. And after that, finally, the tax payable is how much? The tax payable, students, is how much? In this case, the tax payable is, can you give me the full answer? Can you all give me the full answer? Quickly, students. $179,400 minus 15,000 has to be 164,400. 164,400. Is that clear to all of you, students? All of you are clear with this one? Now comes this real game. And let's paste the real game now. I will now take you to the relevant provision. Students, Shelly, Amrita, Sunny, Mamta. I will now take you to the real provisions in this case. And based on that, there is foreign tax credit rule. And this rule number 115, this needs to be applied. And only then you can say your understanding of the double taxation is complete. Only then you will understand that a double taxation is complete. Now, very important MCQ question. Very important MCQ question. Want to see the important MCQ question? Are you ready to see the MCQ question, friends? So the very important MCQ question is this. What is the purpose of the treaty? Or what is the purpose of the agreement which the government of India enters with the foreign government under Dtwa? What is the object on which the agreements are entered by the central government and the foreign governments under Dtwa? Please see. Up till now, students, herein the purpose was for granting the relief. Up till now, students, the purpose was for granting the relief for income tax which has been paid both in India and in that country. Granting the relief for the income tax which is paid both in India and in that country. Obviously, we know that. There is also to promote mutual economic relation, obviously, like India-Mauritius Treaty, wherein India, for now it is not there, but at one point of time, India deliberately forgone its right to tax on the income which is capital gains earned by Mauritius resident in India. So why India has forgone that? To promote a mutual economic relationship. That is what it is. Good evening, Ashwini. Thereafter, students, for avoidance of double taxation, we all are aware, students, on this particular part, for avoidance of double taxation. But what is more important, students, is that the Amendment of Finance Act 2020. Now, the objective of the treaty, students, is also to ensure that we should not give any opportunity. We should not give any opportunity for a double non-taxation. For a double non-taxation. So that opportunity which exists towards the double non-taxation, which I was just telling you about India-Mauritius right now, which the treaty just before, some time back, in which case there was a clear case of a double non-taxation which was happening with India-Mauritius. Because as per the treaty, this income was not getting taxed in India because of the treaty provision which allowed a resident of Mauritius earning a capital gains in India not to be taxed in India. Earning a capital gains in India not to be taxed in India. That was the position of the treaty. And the same income, which is the capital gains income, which when they take it in their country, there is an exemption given on that. In their country, there is an exemption given on that, and therefore we say, students, this gave rise to the concept of a double non-taxation. Now, whether today this concept, will it survive? The concept of double non-taxation, students, whether this concept, will it survive? To that the answer is no. This concept, students, will never survive, and this is what exactly is the point. Now, how about this particular thing, students? What is the other purpose of the treaty? The other purpose of the treaty is also to exchange the information. At the end of the day, students, this is going to be a game changer. The exchange of information from this country to another country, even this happens to be the purpose of the treaty. And last but not the least, the purpose of the treaty is also for the recovery of income tax. And that is the reason why we find Mr. Vijay Mallya has defaulted on the payment of loan but not on the payment of income tax. Because if he would have defaulted on the payment of income tax, then the Indian government, based on the treaty between India and UK, would have got the right to liquidate the property of Mr. Mallya, which was there in UK, to recover its tax. Because that is also the purpose of the treaty. Now, students, in this context, students, herein, this is also very important for MCQ purpose. Again, a very important MCQ question that could be targeted. Very important MCQ question that could be targeted. Read 1, 2 and 3, students, quickly. Read 1, 2 and 3. So the first one, students, is about what? As you all are aware, the terms is used in the DTAA primarily. Okay, terms which are used in DTAA. Okay, but that term has not been defined either under the agreement or under the act, and the central government, through a notification in the official gazette, seeks to define that term which is used in the treaty. So what is the position here? What is the position that we are taking? We are taking that if the term is neither defined in the act nor it is defined in the treaty, but the central government through an official gazette has sought to define this particular term, then that meaning will be taken into account to do the interpretation of the treaty. Then that meaning will be taken into account for the interpretation of treaty. But hold on to this one, students. Herein, this particular meaning primarily shall deem to have come in effect from the date on which DT. So this of the central government through the official gazette may have given the meaning maybe tomorrow, but it will have a retrospective effect. It will have a retrospective effect, students. Keep that in mind. So this will have a retrospective effect, students. Keep that in mind. Coming to point number 2, term used in DTAA. Obviously, the DTAA will always prevail if it is already defined. Just I told you about royalty income some time back. The definition of royalty income which was there in the treaty versus the royalty income under the act. So if there's a definition under the treaty and the definition under the act, so whether the definition of the treaty will that prevail? If there's a definition under the treaty and the definition under the act, then whether the definition under the treaty will that prevail? And the answer is yes. And in the case, if it is not defined in the treaty but defined under the act, then in that case, whether we can take up the meaning as per the act? Again, the answer is yes. We can take up the meaning as per the act. Now, students, in this important point, just read this point number 1. In this important point, just read this point number 1, students, in this context. This was once asked in the examination. The charge of tax in respect of a foreign country at a rate higher than the rate at which the domestic company is chargeable shall not be regarded as a less favorable charge. Students, there is in the treaty, there is a concept of the non-discrimination clause. So there is a clause for non-discrimination in the treaty, students. There is a clause for non-discrimination in the treaty. Now, if I go as per that particular clause of non-discrimination, students, if I go as per the clause of non-discrimination, it says that you cannot differentiate a non-resident with your own resident under your domestic law. You cannot differentiate the non-resident with your own resident under the domestic law. That is what the treaty always provides for. So one doubt that comes in our mind, that if under the treaty I cannot differentiate the non-resident with my resident under the domestic law, but I find that under the act the foreign company is taxed at the rate of 40%, whereas the Indian company is taxed at the rate of 30%. So here comes a case of a discrimination. So therefore they have specifically made an explanation to suggest that if a foreign company is taxed at a rate which is higher than the rate applicable to a domestic company, then kindly don't consider that rate as a discriminating rate. They have used the word less favorable charge. It's been the same thing. Kindly don't consider this to be a rate which is discriminating a non-resident with the resident in India. Don't consider it in that particular way, is the message which is there in this point number 1, which is actually an explanation to section number 90. If this is clear to all of you, students, then we are now very close in the striking distance, students. We are now very close and near to the striking distance. Students, I want all of you to hear in Just now I have given you the example of Mr. Patel, and in that example of Mr. Patel, that 3 lakhs was the foreign income, which in situation number 3 was included in the total income. Isn't it? That 3 lakhs was a foreign income which was included in the total income. But the problem is that the foreign income also you are given. The foreign income is also you are given in INR. The foreign income also you are given in INR. What if in May 22 they give it to you in US dollar, which they have done it in June 2021 attempt? What if in May 22 they give you the foreign income in US dollar, which they have done it in June 2021 attempt? So how you are going to do that question? So students, in that particular case, you need to now convert the foreign income which is quoted in foreign currency, that needs to be converted into INR. That needs to be converted into INR. Now many students are saying, sir, how do we convert into INR? So students, keep in mind this. There is a interest on securities. There is a dividend income. There is a dividend income, students. Okay, and then also here in students, just for these income, we take the month in which it became due. For these income, for the month in which it became due, the previous month last date. You will take what? The previous month last date, whatever is the TT buying rate, whatever is the TT buying rate of conversion, that is what you are going to take and apply it in the foreign currency so as to get the amount in INR. And apply it in the foreign currency so as to get the amount in INR. This is what you will do. I hope that all of you are clear with this one. So if it is an interest income or dividend income, then in that particular case, you will, the month in which it became due or the month in which it became accrued, you will take the previous month last date, the last month last date, and whatever the TT buying rate on that date, you will apply that rate on that foreign income quoted in the foreign currency to get that foreign income in the INR. To get that foreign income in the INR. That is point number 1. In respect of all the remaining income, students, in respect of all the remaining income, students, that is salary, house, property, PGBP, IFOs, etc. In respect of all the remaining income, students, you just go with this concept. And what is that? Whatever is the TT buying rate as on the last date of the previous year, whatever is the TT buying rate as on the last date of the previous year, that is what will be considered for the purpose of conversion of the foreign income quoted in foreign currency into INR. The foreign income quoted in foreign currency into INR, this is what you are going to do. So it is interest on security and dividend income, that is at one place, versus the other income like salary, house, property and PGBP income. For that, you will always go with the TT buying rate on the last day of the previous year as a conversion factor for converting the foreign income quoted in foreign currency into INR. I hope that every one of you are clear with this one now. So this rule 115 will be made applicable in case they give it to you the foreign currency, the foreign income in foreign currency. If they give it to you the foreign income in foreign currency, and if this is clear to all of you, we come to our last particular point, which is rule number 128. We come to our last particular point, and after that I'll do with you one practical question also. Rule number 128. This is a rule for the foreign tax credit. Welcome to the new course, students. This is rule number 128 for the foreign tax credit. It's a simple thing. I've done everything with all of you. It's a simple thing, students. I've done everything with all of you. What you only need to now consider is this. What you students only now need to consider is this. And what you are going to consider it? You shall consider from this to this. Read this one out quickly, students. So students, if you are ready with this one, students, in this context, so foreign tax credit, country for which it is available in respect of the country. So please understand the name itself. Always keep your name very clear in your mind. Foreign tax credit. As you know, we give a foreign tax credit to a resident against his tax liability. Just now I gave you the example of Mr. Patel, the situation number 3. And what was that situation number 3? Against the tax liability of Mr. Patel, in which was included the foreign income, in that particular case, students, the foreign tax credit was made available against his tax liability. The foreign tax credit was being made available against his tax liability, students. All of you agree to this one? Yes. Now, if this is the case, let's have a look. Foreign tax credit, country for which it is available in respect of the country with which India has Dtwa. So that is section 90. So taxes which are covered under that tax treaty. Taxes which are covered under that tax treaty, student. Beautiful question was there in July 2021 attempt on this. I'm not discussing that particular part, but still. Point number 2, in respect of any other country. Which is that any other country? Any other country means with whom India don't have treaty. With whom India don't have treaty. India do not have a treaty. So in respect of any other country, which it will mean that with whom India don't have any treaty, the tax payable under the law in force in that country in the nature of income tax. So I think many of you are aware, if you don't have the treaty, then you get a unilateral relief. That unilateral relief under section 91, you also are aware that even that is as per the foreign tax credit method, FTC method. The unilateral relief under section 91, you will realize that even that is as per the foreign tax credit method. Do you all realize this one, students? So even that is as per the FTC method. Now in the first particular case, this is where the treaty exists. And in the case where the treaty exists, then there is section 90. And in 90 also, with example of Mr. Patel, which I gave it to you, where the treaty existed, the relief will be given only through the foreign tax credit against the tax liability of that resident person. Against the tax liability of that resident person. Now the eligibility to claim, you all know, it is only a resident who can claim the foreign tax credit. And that is the point. We will not give a credit concept to Mr. Donald Trump. Primarily, we are giving the credit. Let US worry about Donald Trump. We will worry only our citizen. And that is Mr. Patel in my example. So only a resident can claim the FTC. The second point is that tax should have been paid. This is very important. If the tax remains payable for whatever be the reason, forget it. You cannot take the credit out of it. And please be careful. It is equally important, students, if you want to claim the credit, the corresponding income should also be offered to tax. What does it imply? It should be a part of, the income should be part of the total income. The income should be a part of the total income. So the income that has been part of the total income, is it possible to have a foreign income? Without having the foreign income in your total income, can you claim a foreign tax credit? Without having the foreign income in your total income, can you have a foreign tax credit? Answer is no. This situation cannot prevail. That without having a foreign income, you want to claim a foreign tax credit. This situation is not possible. And that is the reason why, students, that is the reason why all of you keep in mind this. That is the reason why, students, all of you will keep in mind this particular point. Are you getting this one, students? Are you getting this particular point? In the situation number 2 that we did, what is that point that we did in situation number 2? What is the point that we did in situation number 2, students? You should be aware of that. The point that we did in situation number 2 was, remember situation number 2, where in the case of Mr. Patel, who earned the royalty income and in the country, which country? US. So US was country of source. In that situation, 2 said it will be only be taxed in country of source. So you tell me, in that particular case, situation number 2, can you claim a foreign tax credit? When the income will only be taxed in the CUS, which was US in my example, whether that income, can that be subject to any foreign tax credit? Whether the income, can that be subject to any foreign tax credit? Answer is no. Because the income was not forming a part of my total income. And therefore the question of getting a credit will not arise. And who stopped you? Who stopped you to consider that income as a part of your total income? Who stopped you to consider that income as a part of your total income? The treaty stopped you. Because only charge in COS. But you were allowed to take that foreign income into account for rate purpose, and therefore we calculate the rate separately. Now the foreign tax credit is available for income tax, surcharge and cess only. Okay, so no foreign tax is available for penalty and interest. Okay, no foreign tax is available for penalty and interest. So please understand income tax, surcharge and HEC. For that you get the foreign tax credit, but nothing for penalty under the income tax law, nor for interest under the income tax law. Consider this. What they say, compute for each source of income. What to compute? Lower of what? A and B. What is A? Tax which is payable under the act versus the foreign tax which is payable. The tax which is payable under the act versus the foreign tax which is payable. So consider that herein it should be the lower of the following two. The tax payable under the act compared to this with the foreign tax amount and the lower of the tax. So if supposing the students, and obviously if there are 2 countries, then obviously for each country you will calculate the credit separately. For each country, students, then you will calculate the credit separately. Isn't it? Students, read this last point. I will not explain you the last point, but I will explain you through a practical part. In the practical which we will just now do, at that point of time, I will explain you this part. Read this one. Just read it once. Done, students? Now with that, students, you will read this question and maybe after that take a 5 minutes break. After reading this question, you will take a 5 minutes break and we will resume in 10 minutes. So 8:10 we will resume this question. Which one? Mr. Patel. This is the ultimate question, students, and this is what I just need to explain to all of you. The last segment, Mr. Patel. All of you students, deal with this question now and try, if you possible, try to figure it out how to solve it. 5 minutes your own solving time and 5 minutes break, and then we'll resume in 10 minutes. Quickly, students. Sunny 9 o'clock. After this, we'll hit the equalization levy. So welcome back, students. क्या आप सभी लोग ने पढ़ लिया इसको? बताइए. All of you have studied this one, students? So students, here this is a real application, and I will suggest to all of you to just go through more questions after this. I'm doing one question in the revision lecture, and do follow it up with the remaining questions which are there in your whatever book that you're referring for getting the full-fledgedly clarity. We will be done with this particular topic completely now. Mr. Patel, a resident of India, a senior citizen, gives you the following information. He owns building in London. The same was on rent at this amount, 12,500 per month. Municipal tax paid was upon 10,000 was paid in London on 12th of February 2022. He paid interest on loan taken for construction. Now please understand here, he has taken the loan, interest on loan. See, if you are a resident, then your world income is taxable. How your world income will be taxable? The taxability, students, will be done normally. In the normal way, the taxability will be done. So there are no special provision that you should worry about it. There are no special provisions, students, that you should be worrying about it. The taxability will be done normally. Okay. So the same was on rent for this pawn. Municipal tax paid. So you will also get a deduction. So like GAV, less municipal tax paid, that deduction you get. Thereafter you get the NAV, isn't it? Then from the NAV, standard deduction, thereafter the interest. So therefore this 13,000 per annum UK pound, you will get a deduction. Tax was deducted at 10%, so this is the foreign rate. This you get to know the foreign rate from this particular source. Withholding tax, sorry. This is the tax which was on the interest. This is the tax which is on interest. But the foreign rate is a withholding tax which is 20% on the rent which was being deducted by the tenant on 31st of March 2022. So therefore the 20 rate becomes the foreign rate. The 20% becomes what? The foreign rate which is to be considered. This 20% foreign rate will be compared with the Indian rate, which we will calculate it in this question. Second point, he had a chain. Now this is the second source. The first source is the rental income. Now I will try to take you through a comparison about what we get in this question and what you find it in the ICI question, so that when you read this ICI question, you are very conscious about this particular factor. Let's do first point number 2. He had chain of departmental stores in India and a branch in London. He followed cash basis of accounting. Following information was provided: gross receipt and thereafter the expenditure. Now obviously, students, there is this in India and then there is this in UK. So you will reduce this expenditure from the gross receipt. All of you agree to this one? You will reduce this expenditure from the gross receipt because it will be calculated normally. You are a resident. The world income is taxable under the Act, and therefore when you have to calculate the business income, that business income also will be computed normally. When this would have been a case of a non-resident, and the non-resident may have got like income like royalty and FTS or interest, then suddenly we get the special rates on which no deductions are allowed. But because you are a resident, students, the income will be computed normally. So what happens, even in the case of the UK branch, the expenditure that you have incurred will thus be allowed as deduction, and the answer is yes. Now one point before we can proceed further, there is this UK branch. This is in UK pound. Also the first point that is there for the building, for that also there is a pound that has been given to you. Now as you all are aware that the pound needs to be converted, the pound needs to be converted into INR, that because the foreign income is denominated in foreign currency, and the fact that the foreign income is denominated in the foreign currency, the same needs to be converted into the INR. the same needs to be converted into the INR. And that exactly is the point. So you will be converting this particular rate into the INR. Now when you have to convert this into the INR, students, be very careful about this point also. When you have to convert this particular rate into the INR, then in that particular case, what is that we will say, students? In that particular case, students, what is that we will say? In this context, for the rental income and the business income, the TT buying rate, students, the TT buying rate as on the last day of the previous year is what has to be taken into account. The TT buying rate as on the last day of the previous year, that has to be taken into account. Do you all agree to this one? For rental income and for the business income? Yes. So that is what you will take it, and accordingly you will do the conversion. Now apart from this, for Mr. Patel, here Mr. Patel has made investment in shares of companies in UK. Dividend received on 31st of March 2022 is UK pound 2500. TDS at 10% on the date when the dividend was paid. So now you tell me, for dividend income, which is also in the foreign currency, this dividend income foreign currency as per rule number 115 which I taught you, how do you do the conversion? The conversion would be on the basis of the TT buying rate. Now when it became due, 31st March, which TT buying rate that you will adopt in this case? 28th March TT buying rate. 28th March TT buying rate is what you are going to adopt in this particular case. I hope that all of you agree to this proposition. 28th of March, you will adopt the TT buying rate, students, in this case. Fine, and that exactly is the point. You are required to calculate the tax liability of Mr. Patel, and this is what it is. So 20th of February. 20th of February, the TT buying rate is what has to be taken into account. For the dividend income. For the remaining house property and the business income, 31st of March. Okay. Now by the way, before we proceed, as far as the tax on the business income in UK, the tax on the business income in UK was paid on 30th of June. 30th of June, this is one information that you keep in mind. I will be using this information. The tax was being paid on 31st of March. And what about this one? What about the house property tax? When it was being paid? The house property tax was being paid on 31st of March 2022. Business income tax was paid on 30th of June 2022. And for the dividend income, it is paid on 31st of March 2022 itself. It is paid on 31st of March 2022 itself. Fine. If you all are through with this one, students, please have a look to this computation provision. How you compute it. A full-fledged problem. Beautiful problem. So I told you to compute the income normally. Now one important suggestion to all of you is this, that please don't do the conversion at individual level. Never do the conversion at the individual level. If you have to compute the foreign income which is denominated in the foreign currency, I will suggest to all of you, keep computing that foreign income in the same foreign currency. Keep computing that foreign income in the same foreign currency. Arrive at the net amount. And on the net amount, apply the TT buying rate. On the net amount, students, applying the TT buying rate. And that will give you this particular amount, which is 51 lakhs. Now the other particular part, which is this one, if you see over here, the Indian business gross receipt, students, and the expenditure. So that is normal. Foreign UK business, you compute it at the foreign currency. The net amount is then converted into INR. Which INR? 31st of March. For both you are taking 31st of March. And you get this particular the foreign income 10,50,000 and the total business income would be 60,50,000. Now the dividend income 2,500, nothing to be computed. Directly 2,500 into the TT buying rate on 28th of February. This is 28th February. So 1,55,000 total income, and then you start calculating the tax liability. Students, here the total income is around what amount? 1 crore 13 lakhs 5,000 rupees is your total income. Your tax liability, students, do as per the slab rate. And once you get the slab rate, the total tax 32 lakhs 1,500, surcharge would be at 15% because the total income exceed by 1 crore, surcharge at 15%. So this is a surcharge amount. Take the subtotal, you got it, add HEC on this, and thereafter the tax liability, and now you get the Indian rate. How you get the Indian rate? Just nothing, students. The tax liability till HEC, divided by total income. You will get the average rate of tax. Which is 33.87%. Now you do the foreign tax credit. Now, students, you do the foreign tax credit, and in this particular foreign tax credit which you are doing it, section 90 read with rule number 128. Section number 90 read with rule number 128. How you proceed in this case? Now please see how we have done it. Please see how, what did I told you? Eligible rate. Please recall. Eligible rate would be, check what I taught you right now. Eligible rate would be the lower of the two. What is the lower of the two rate? One is the foreign tax rate, which is 20%. Compare this foreign tax rate with the average tax rate of 33.87%. Compare this foreign tax rate with the average tax rate of 33.87. So you take 20%, the lower of the rate, apply it on the which is this income? This is the portion of the foreign income. What is this 85,000 pounds? 85,000 pounds is the portion of the foreign income which is doubly taxed in both the countries. Please understand, in India, so far as India was concerned, only 85,000 pound entered in your total income after converting into the INR, but it was only 85,000 pound entered into the total income. Maybe when it comes to this one, students, maybe the tax would have been paid on the rental income. The TDS was deducted by the tenant on 1,50,000 pound. I agree to this one, that the tenant has deducted a TDS on the rent amount of 150. But what portion of this rent entered in my total income on which the tax was charged? The portion of the foreign income which entered into my total income was 85,000 pounds. And therefore, the foreign income, the portion of the foreign income which was taxed in both the countries is up to 85,000 pounds. And that is what you will be taking into account. So 85,000 pounds multiplied by 20%, which is the lower of the two rate. And once that has been multiplied by 20%, being the lower of the two rate, you will get what? You will get the foreign tax credit. But is this foreign tax credit in UK pound? Yes. Is this foreign tax credit in UK pound? Now you need to convert into INR. How you will convert this foreign tax credit amount into INR? By applying the TT buying rate as on the last day of the preceding month. Preceding to which month? The month in which the tax was paid. Now here the tax was being paid on 31st of March. In the first case of rental, because the TDS was deducted on 31st of March. So the TT buying rate on 28th of February is what would be taken into account, which is 62. So therefore, this is 62, which will be multiplied by this particular amount, and that gives you the final answer. Similarly, as far as the business income is concerned, how much of the net business income entered into my total income? It was only up to 17,500. On that 17,500, you will apply the eligible rate. The eligible rate would be the Indian rate compared with the foreign rate. Foreign rate is 40%. Indian rate is 33.87. So 33.87 is lower rate. So I go with this. And by multiplying the foreign income, which the portion of the foreign income which was taxed in both the countries, when I multiply this with the eligible credit rate of 33.87, I get the foreign tax credit. But this foreign tax credit is in foreign currency, and because it is in foreign currency, therefore, students, I will have to convert that foreign tax credit amount in foreign currency by applying the TT buying rate as on the last month preceding the month in which the tax was paid. Here the tax was paid in the month of June. Here the tax was paid in the month of June. So I will have to take the TT buying rate on 31st of May 2022. 31st of May 2022. And similarly for the dividend income. Now students, very important point I'm discussing with you. Please pay attention. This question is a full-fledged question. This question that we have just solved is a full-fledged question, students. When I'm saying it is a full-fledged question, means it takes into account everything. Now, ICI has the bad habit of cherry-picking whatever they feel comfortable. So, how the ICI solution changes, keep that in mind. One of the major point of the ICI is that they generally don't give the foreign income in foreign currency. They give it in INR. The moment they give it in INR, this what we did just now, this currency factor conversion, the foreign tax credit, which you converted into the TT buying rate of the last date of the preceding month in which the tax was paid, the moment you convert this with this, entire thing is gone. Do you all agree to this one? Obviously, because if you are having only INR as a foreign income, then you would have realized that in this step of the question of your ICI, you don't do this. ICI questions, when they calculate the foreign tax directly, this is the INR amount. This is the INR amount, students. And on this INR amount, you directly apply the eligible rate. This is the first observation. So if you don't get a full data of application of Rule 115 for conversion of the foreign income denominated in foreign currency into the INR, then this conversion of the TT buying rate, the conversion of the foreign tax credit amount which is denominated in foreign currency into the TT buying rate will not be required. Into the TT buying rate will not be required, students. So that calculation is not done in the ICI question. This kind of a calculation is not done in the ICI question. Be mindful, and what is a reason you should always know. Otherwise, in your attempt, if they give you this TT buying rate and you don't know this, then in that case, gone with the wind, students. That is what I can say to all of you. Point number two, students. In the ICI question, we also find that in the ICI question, students, we also find what? That there is a uniform rate only for all the source that you may have earned in the foreign country. In this question of Mr. Patel, there are 3 rates. There are 3 different rates for the 3 foreign income. One for the 20% was for the rent. That was a tax rate. That was a foreign tax rate for the rent. 40% was a foreign tax rate for the business income. And the last one was a dividend, which was taxed at 10%. So because you had the different rate for each of the foreign income, you are calculating the credit for each source separately. Whereas in the ICI question, they give you only single rate of that foreign country. And the moment you give the single rate, students, then instead of doing it individually, the way we have done it over here, instead of doing it individually, what we can do, we can take a summation of everything. The subtotal of what? In that particular case of the ICI questions, which has been there, what you do is that, students, what you do in this case is that you directly then take what? A summation of everything. This summation is the aggregate foreign income, which is taxed in both the country. Now I am deliberately making you write elaborately this sentence, which is taxed in both the country. Why I am making so much of emphasis on this? Because in ICI question there is one new point which always came into picture. And what was that new point? I'll let you know. In the ICI question, students, you will find that one adjustment, like there is a brought forward loss which is not deducted in the foreign country. There is a brought forward loss in the foreign country which was not deducted in the foreign country. But as far as India is concerned, the moment you are a resident, world income is taxable. And if the world income is taxable, that world income will be computed in the manner laid down under the Act. And as far as the Act is concerned, it provides the provision for set-off of the losses. Yes, there are some restriction, but that restriction is for, like for example, specified business loss, speculative loss, long-term capital loss. So there are limited exceptions. But other than that, whether the set-off is possible, yes. So what happens now? That brought forward business loss from the foreign country, that brought forward business loss, you are now doing the adjustment. You are now doing the adjustment against the total income computation. The moment you do the adjustment of reducing that brought forward loss from the foreign country, your foreign income, your net foreign income taxed in both the country will reduce. Why it will reduce? Because in India, it is only the net foreign income which entered into the total income. So therefore, only the net foreign income will then be considered, because only to that extent there is a double taxation, and that is what the adjustment that you do. One more point, students. One question of Mr. Kalpesh, I remember Mr. Kalpesh question which is very popular. He has earned a royalty income from a foreign country, and that royalty income was from copyright. And because that royalty income was from copyright, accordingly, that royalty income from copyright under the income tax law is subject to the deduction of any expenditure against that royalty income. Plus, also it was eligible for 80 QQB 3 lakhs deduction. And by doing these deductions of the expenditure on that royalty income and thereafter 80 QQB, what has happened is that royalty income after these two deductions get reduced further, and finally what settles down in the total income on which the tax is charged, is the reduced royalty income from the foreign country. So only on that reduced royalty income from the foreign country, that much portion only is subject to double taxation, and only on that reduced portion of the royalty income, only on that portion, students, you will then go ahead and take the credit calculation by applying the lower of the two rates on this reduced royalty income. This is how you do it. And then thereafter, students, primarily this is the kind of a question that you do, because the limitation of the ICI. So therefore, what I taught you is that please try to distinguish. This is a full-fledged question that we did, but you should also be smart enough to what is the kind of question which the ICI has been asking in the past, and what is the logic why we do that. I hope that every one of you are clear with this one now. This more clarity, students, you will get it. Please immediately after this lecture is over, you will go through those ICI questions and just see whatever I've told you just now, does it hold good or not. With that, students, we are done with this. Congratulations to all of you, students. We are done with this particular double taxation relief questions completely. We have done with this particular double taxation. Now there is one theory particular area of this particular context, which is of the permanent establishment. This is a very popular theory which has been asked. Sometimes they ask you what do you mean by the term permanent establishment, and sometimes they also ask you what is the significance of the permanent establishment. So what constitute the P and what is the significance of the P? These are the two very most popular questions which are targeted in the examination. Now how do you resolve this one, students? First of all, if they ask you what is P, simply says that P means a fixed place of business through which the enterprise carries on the business. Now P can be of three types. This definition of P is as per the treaty, is as per the DTAA. The P, students, can be of three types. One is that P which satisfies the physical criteria. You'll say, sir, what do you mean by the P which satisfies the physical criteria? It means your office, your premises, means all yours. So the P which satisfies the physical criteria. So that results into the exposure of P in the other country. So if you have got your office, your branch, your factory in the source country, then can we say that you have the P in the source country? Yes, we can say that. This is criteria number 1 as per the DTAA, the P which satisfies the physical criteria. Second one is about the P which satisfies the subjective criteria. Subjective criteria means, students, that you may not have your office, your place in the source country, but there is a place which has been given to you where you have the right to use that place. So you don't have your own P, you don't have your own office in that source country, but do you have the right to use that particular place in that source country? If the answer is yes, then you are fulfilling the subjective criteria, on the basis of which we can say that there is a P exposure of yours in the source country. There is a P exposure of yours in the source country. And the last but not the least, the functional criteria. What is this functional criteria? Functional criteria means that you have your agent in that particular source country through whom you are performing the business function. You are having the agent in the source country through whom you are performing what? Students, you are performing the business function. We can accordingly say that this satisfies the functional criteria. So these three can give rise to a permanent establishment exposure of whom? Of the non-resident in the source country. And if supposingly, what is the significance of this? If you have got the P exposure in the source country, what is the significance of this? The significance of this is that the business profit of the non-resident will be taxable only if the business profit of the non-resident will be taxable in the source country only if it has P exposure in the source country. And if it has the P exposure in the source country, then whatever is the business profit which is attributable to that particular P in the source country, whatever is the business profit which is attributable to that particular P in the source country, that much portion of the business profit only will be charged to tax. That much of the business profit only will be charged to tax in the source country. This is the significance of the P. So that is what it is. And the last, students, one important particular point of the theoretical part is this one, and this is about the tiebreaker rule. Students, as you all know, students, tiebreaker occurs, say in this case, when you become a resident of both the country. The tiebreaker occurs when there is a resident as per the domestic law of your countries. As per the domestic law of the countries, you are considered as a resident of 2 or more countries. Like for example, in India, you become a resident on the basis of the number of days of your stay, whereas in say USA, you are considered a resident only on the basis of you being a citizen of US. So if you are a citizen of US, they consider you to be a resident of US. So that is how you become. Can we say in this case, that is how we can say that there is a classic case of, students. Classic case of what? There is a classic case of a tie break that has happened because you are a resident of both the country. Now what will happen? World income will be taxable in both the countries. That is impossible. So one country, you need to know that in which country you can effectively be considered as a resident, so that the other country can become a country of source. You need to know in which country you will be effectively be considered as a resident, so that in the other country you can become a non-resident. So that rule, tie-break rule, is given to you in treaty. In the DTAA, students, the article number 4 generally, article number 4 of any treaty gives you the solution. How to resolve this sort of a scenario where you are resident of both the country and now you want to find out effectively for which country you can be considered as a resident, so that for the other country you will be considered as a non-resident. So article number 4 says that the tie-break rule, that you need to go sequentially. you need to go sequentially would mean that here what is required is the place of permanent home. Which is your place of the permanent home, students? That needs to be identified. Which is the place of your permanent home? So like you have permanent home in which country is what you need to identify first. If you say, sir, I have got permanent home in both the country, then you go to the next step. Next step would be that center of vital interest, economic and personal. Mainly in your examination, students, you will get the answer from this only. ICI have targeted in the past the answer to be derived from this only. So economic and personal interest would mean that economically where I'm better off, and personally also both has to be taken together. Where my family stays, where I also stay, all these things are to be considered. So that is how primarily you will have to see. But if you say that economically I'm getting the income from both the countries equally, part of my family is here, part of my family is there, then you then go to the next step to find out where you can be considered as a resident. The next step is the place of habitual abode, where we can say that you are habitually residing. So habitual abode means primarily where you are residing habitually. So that country will be the country of resident. Again the same issue. You will say, sir, I am residing 50% here, 50% there. Then the nationality. Which country national you are, where you are doing the voting. I say I am dual national citizen. Then even Article 4 says, thank you very much, we cannot resolve. Please do one thing. Check with your CBDT and check with the US this guys, the revenue authorities, by filing a MAP application. By filing what? A MAP application. What is MAP? The Mutual Agreement Procedure. So here you will make an application to your particular CBDT asking that, look, this is a situation which I'm stuck. I'm a resident of both the countries, and as per article number 4, from point A to point number D, I'm not in a position to get my answer. Kindly you both, you means CBDT in India and the tax authorities in US, you both decide which country you should be treating me as a resident, so that the other country I will be considered as a country of source. That exactly what this tiebreaker rule is all about, students, and we are done with this double taxation completely. My suggestion to all of you is that, students, very quickly, very soon, you should see the ICI practical problem, because I have discussed this one with you. And therefore, I can tell you that you will hardly take 15-20 minutes to wrap up all these questions at one go. Okay, but if only if you are doing it immediately. Now, students, next Saturday and Sunday agenda for all of us, would be the equalization levy and the transfer pricing. The equalization levy, students, and the transfer pricing is what I'm going to do with it, so that I'm done with this completely. NR taxation and transfer pricing. Equalization levy and the transfer pricing is what we are going to target primarily in our next particular Sunday next session, students. And that exactly what it is. For you, students, the slogan, as you all are aware, to ask you, this is a slogan which is meant for all of you in the chart. Fine, students. So with that now, students, this is what it is, the end of the session. Now very quickly, students, the one of the announcement of Unacademy I'll just share with all of you over here in this context. So this is about, students, yesterday. So this is about, students, one very important, students, point which I'll just tell, and you may try to put up with all your colleagues. There is a mega scholarship test, students, which is going to be conducted tomorrow. A mega scholarship test, students, which is going to be conducted tomorrow for the CA Foundation Intermediate Final Group 1 and Group 2. Do tell all your colleagues and all about this particular test, because by virtue of which, students, they will immensely be benefit. So say for the inter results are out just now. So by virtue of the results which got out just now, I think all of you are aware, many students, they will, if they give this test tomorrow, they will be ending up with the scholarship in the Unacademy platform. So do let them know about it, and accordingly let these students take the benefit of the scholarship test. This is tomorrow. You'll find in the Unacademy app, and that exactly is the point. With that, students, take care of yourself, students, and I'll see you in the next class. Thank you very much. Bye-bye. Next Saturday would be at 5 o'clock. 5 to 9 o'clock next Saturday. And Sunday, 7 to 1. Okay, that is the schedule for the next Saturday and Sunday class. Okay, students, take care.